ahead of the election. The conventional thinking has been small caps help Trump. So what happens if it's Kamala Harris and even a blue sweep come November 5th?
No, it's a great question. And so if Harris wins, what we think is the outcome for small caps over a 1 to 3 month period is in-line returns to the market to down about 3%. The issue with Harris is we don't really understand or know her policy, and the market's not that comfortable. So we were trying to figure out, how do you handicap Harris? And we're in a situation where you're post-easing cycle, the election's coming up, small caps have really underperformed, and we took all that and we combined that and we said, okay, what makes sense to us is more of an in-line to down 3% type situation, because typically you see a very positive reaction after the election, a so-so reaction after the Fed starts cutting, and recently it's been so-so. So we combined all that, we come up with an expected return that's just okay, right? So it really, you're behooved to really make that bet that the market's going to start to price in this positive expected return.
What are you still hoping to learn from Kamala Harris in terms of economic plan? Many say this will just be a continuation of Joe Biden in some senses, and they also did just put out an 82-page document.
Yeah, I don't know if I'm not looking to learn that much. One of the things I think the market is missing, and one of the things that's a big risk, is that if Harris wins, we probably see taxes roll off, and that's not great for small caps. Now, that won't happen initially, which is why we're still thinking of a small pullback or underperformance. But if we go longer term, that won't be great. And your point about Biden, and if you go back to Obama, Biden, and then potentially Harris, you're going to likely see a situation that's a lot more beneficial to growth and growth companies, because some of their policies haven't been great for the economy or held back the economy, whether it's related to regulation or other issues, and that's been a great environment for growth and growth stocks.
Forgive me for getting super short term. Let's get super tactical though. The next month, what do you think October's going to look like? Are we going to get that kind of policy anxiety in this market that provides a substantial headwind to stocks overall?
John, one thing that's confused me is typically before an election, when you have this kind of uncertainty, you don't usually see equities go up, right? And now we've had some mitigating factors. We've had the Fed cut, we've had China, so on and so forth. So I do expect to see a lot more back and forth. And what I expect to see is small caps to outperform and the broader market to be more of a consolidation and maybe some downside. And so that's another reason why we're looking into the situation. You really just haven't seen that uncertainty, and there's a lot of uncertainty there.
To John's point, though, typically October is a difficult month. Right. Going into an election year, it's even more difficult.
Right.
Policy anxiety has been looming over people's minds, but nobody wants to act on it until they're about a week away from the election. Right. Why do you think this market, even the small caps, can sort of shake that off?
Yeah, I think they can shake that off because, again, if we go back to where the market is, where consensus is for GDP, it's down around 2%. I don't think we're in a 2% GDP market. I think it is, maybe it's not 3%, but I think it's a lot higher than that. One of the things that we talk about a lot on the show is that credit spreads, IG credit spreads are 89, 90 basis points over. That's not showing a whole lot of economic stress. And so when you ask us where that catalyst is, I think it really is the market realizing that the economy is a lot more robust than a lot of people think.
Chris, what happens days after the election if we don't know who won?
Oof, I don't think that'll be a great situation. I think the market will have a real big problem with that. We expect to see volatility to spike. I would expect to see the market to pull back. Until we get resolution, the market trades heavy in that kind of situation. That would be a really tough one.
Chris, it's good to see you, as always. Thanks for the call on the small caps. Chris Harvey of Wells Fargo Securities, and on China as well. I'm pleased he brought up some of the casinos. Las Vegas Sands last week up by close to 22% on a single week.
All of a sudden, you have consumers that are being given cash infusions to go spend, and potentially, where do they like to vacation?
Macau.
Exactly. So this, to me, just shows how people are able to play this with more fail-safe FOMO trades.
Futures down about 0.2 on the S&P this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. German Foreign Minister Annalena Baerbock telling Bloomberg in an interview that the war in Ukraine is weighing heavily on the country's economy.
This is why we have to be aware that Putin's war of aggression is not only a military attack on Ukraine. This is hurting everybody. Why is our budget very much stressed, to say it very diplomatic? Because we thought that the war of aggression would never come back to the European continent.
Baerbock also telling our own Anne-Marie Hordurin that she supports Ukraine's request for long-range tourist cruise missiles, putting her at odds with German Chancellor Olaf Scholz, who has so far ruled out sending the weapons over fears of triggering Russia further. Meanwhile, in Europe, Stellantis shares are falling after the Jeep maker slashed its profit margin forecast for the year. The car maker saying it plans to dial back production and spend more on promotional incentives in a slowing and more competitive auto market. CEO Carlos Tavares is facing pressure from investors, dealers, and unions over declining sales, a dated U.S. vehicle lineup, and bloated inventory. Meanwhile, AT&T is officially exiting the entertainment space. According to a new filing, the telecom giant has agreed to sell its majority stake in satellite TV service DirecTV to private equity firm TPG. The sale will total roughly $7.6 billion in cash payments through 2029 and give AT&T the ability to focus on its core business, which is wireless and fiber connectivity operations. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, fighting for last-minute momentum.
The team that actually has a plan is the team of Trump-Vance.
It's pretty obvious to us that Donald Trump and J.D. Vance do not share our values in any way.
That conversation just around the corner. Live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equity futures on the S&P 500 negative here by 0.25%. Just a little bit softer moments ago. Chris Harvey of Wells Fargo. Lisa, teeing up small caps for some outperformance here into year-end.
Talking about just what he's seeing with respect to the earnings picture, but he kept going back to a theme, and I think that it's a really important one because it really dovetails off of what Brian Weinstein was saying. He believes this U.S. economy is much stronger than many people believe. He sees the broad expectation by economists at 2% of GDP growth, completely in contrast to Atlanta Fed GDP's 3% prediction. And frankly, that has been more right than a lot of the economists' forecasts.
Let's see if the data backs up that story throughout the week. Under surveillance this morning, fighting for last-minute momentum.
Governor Walz and I are going to debate the issues that matter to the American people. And what I'm going to try to show is very simple, that the candidacy, the team of substance, the team that actually has a plan, is the team of Trump-Vance.
It's pretty obvious to us that Donald Trump and J.D. Vance do not share our values in any way. Elections have consequences. It is Donald Trump or Kamala Harris.
So here's the latest. VP candidates J.D. Vance and Tim Walz facing off Tuesday in the last confirmed debate of the neck-and-neck presidential race, both attempting to boost each other's campaigns' momentum while avoiding any damaging missteps just 5 weeks before Election Day. Joining us now to discuss is Henrietta Trays of Vader Partners. Henrietta, let's talk about that word momentum. Who has it right now and who doesn't?
You know, that's a great question. If we look at just the numbers, I had to go over this a couple times. In August, the Harris-Walz campaign raised $287 million, and the Trump-Vance campaign raised $85 million. So if you look at the expanding electoral college map, the number of states that are now gray instead of red or blue, the momentum is plainly, I think, behind the Harris camp. And I think that's something that she needs to grow in order to win. But that's been the story since she got into the race.
But something we have seen the Trump camp do is go out and get free media. For instance, Donald Trump showing up this weekend at the Alabama-Georgia game. That is working more to his advantage. Does she need to do more events like that, get out there and be more in these, you know, interview or just, you know, by the seat of the chair kind of moments?
Yeah, those campaign moments are so integral to Donald Trump, especially in galvanizing voters. Democrats are more galvanized this cycle than Republicans are. It looks a lot like the 2008 scenario. It's about 84% for Democrats to 71% for Republicans. So that enthusiasm going to a football game is also a great strategy there. The Harris team's strategy is to go on very niche, specific media outlets, whether it's a podcast or a specific news outlet in a specific district and town in a swing state. So very micro-targeted. And I think the earned media is something that will come up in the debate tomorrow night. You know, J.D. Vance and Donald Trump, well, J.D. Vance in particular is the least popular person across the 4 people on the ticket right now. Tim Walz is the most popular. So I think what they're going to be trying to do is generate a momentum event that, you know, captures voter attention, not tomorrow night, but the days ahead, as the internet gets their hands on it.
Henry, we've seen a widening gender gap in this election cycle. And you write in your note, though, that Trump's gains when it comes to the youth vote look like a mirage. Where is he winning and where is he not winning?
Yeah, I'm so glad you brought that up. The gender gap is also wild. We have to check the numbers again and again. The gender gap with Hispanic voters is 60 points. The gender gap with voters under the age of 29 is 47 points with women versus men. It's really quite stark and sort of a battle to see who really wears the pants in America this year. The youth vote is one where the Trump gains from the entire year on the national scale are not showing up in very specific sort of gold standard youth polls, that of John Del Volpe out of Harvard. And they show quite clearly that any gains Trump has made with young male voters, particularly those on the younger end of the spectrum, not sort of the 29 to 35 cohort, but 29 and under, are being superseded by the 70% support that Kamala Harris gets with all young women. And so that's, I think, really the story of this election is the gender gap.
Henrietta, when I talk to Democrats, the idea they give me, even Governor Cooper, is that they have 2008 vibes, basically when Obama won. But when you look at the gender gap, doesn't that spell 2016 vibes when Hillary Clinton lost?
Yeah, she's doing much better than Hillary Clinton was doing with female voters. The areas where there is not such a gender divide are exactly where you would expect. It's in the swing states. So if you dig into the data out of Arizona or Nevada, North Carolina, Georgia, the gender gap is not as severe as it is nationwide. So what you really want to keep your attention on, and to bring it back to the momentum play, is Harris still has work to do across not just the Rust Belt, which is not in any way safe for her, but also the Sun Belt, though Nevada in particular looks a lot better than I would have anticipated just 4 or 5 months ago. So she's definitely making gains there, but the gender gap is smallest in those swing states.
Henrietta, right now, amid all the politicking and the planned debates, there are 2 acute issues facing the United States. We have, of course, the dock worker potential strike and what that could mean in terms of disrupting trade. We're going to speak about that in just a minute with our colleague Danny Berger. But we're also dealing with the aftermath of one of the most damaging storms that's hit the United States in a very long time, hitting North Carolina in particular, which is a swing state. What are the responses that you're looking for from the candidates that could be constructive or could be potentially damaging?
Yeah, this is the hurricanes obviously are very close to home for me, and I focus on how long it's going to take those districts and towns to come out of this. We're looking at months of recovery time. That is a large swath of the Trump population. Happens to be a place where I vacation regularly. It's very red down there. So I'm nervous about their voting prospects and turnout that's going to be happening while people are literally just trying to rebuild their homes. Getting all that hurricane up in North Carolina is way too far to the north for anybody to be comfortable with, and they're going to be reeling from that for years. I expect that the Harris and Trump campaigns are going to start going there, not once it's appropriate, but certainly by the end of October to try to turn out the vote there. And then on the labor front, certainly it's a major issue for the lumber yards, and something that I think the Biden team has shown repeatedly that they prioritize. But obviously this could start tomorrow, so they need to get on that.
How does Biden prevent this from becoming his Katrina?
I think having a very swift response. I mean, the problem is Congress is already out of session, so they will not be passing an emergency appropriations package. But there's a lot that the president can do in terms of declaring an emergency, which he did before the storm hit, I believe, in Florida and North Carolina, and continuing that effort and keeping the focus on it. But it takes months and years to come out of these kinds of climate events. And that's something that Biden and then the next administration is going to have to prioritize.
Well, when you look at what the president has done over the past 5 days, is already he's opened the floodgates for federal funding for these areas. When you look at potentially more crucial funding down the road, it'll be, as you said, 5-10 years out that Congress actually could potentially put some packages together.
No, they'll pass another spending bill in mid-December, and that bill will include, I would expect, substantial amounts of aid, billions of dollars in aid to these states. It's just that they're gone right now, so they physically can't come in and vote. They're all on the campaign trail in their districts. The House is extraordinarily competitive this year. The Senate has a whole spate of swing state senators that are up for re-election. So all the members are gone and they can't take those votes, but they'll be back in the lame duck and they'll be voting on an appropriations package, with emergency funding in December.
Henrietta, always appreciate the breakdown from you. Henrietta Trades of Vader Partners on the latest in this country. Domestically, things getting messy and getting messy quickly.
You just have to think that these are two pivotal potential events. You have a situation where you could get a strike that could take off $7.5 billion per week that it goes on to the GDP. But then you think about a storm that was catastrophic. We are still tabulating the missing and the dead from this storm, and it was destructive in a swing state that will keep a lot of people away from the polls. So you just have to wonder how this is going to potentially tip the scales.
I'm going to make a good point. If you're trying to rebuild your home, are you really going out to vote? Is that really top of mind in 5 weeks' time?
It's not your priority right now, that's for sure. Coming up on the program, we'll catch up with Bloomberg's Danny Berger in Newark, New Jersey, as East Coast dog workers prepare to walk off the job. The latest on the ground up next on the program. Equity futures on the S&P 500 negative here by 0.2% as we close out the month of September. Your bond market yields higher by a single basis point on a 10-year, on a 2-year up by 3. If you want to know the latest out of China, up, and away. The CSI 300 closing out the day up by more than 8% before a one-week holiday. We got the biggest one-day gain going back to 2008. From New York, this is Bloomberg.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
2 hours away from the opening bell, equity futures pulling back just a touch. We're down 0.2% on the S&P 500. On the Nasdaq, we're down a third. On the Russell, we're down 0.6%. This is child's play. Check out China. CSI 300 absolutely exploding once again overnight, up by more than 8%. Biggest one-day pop since 2008. And here are the gains. Baidu, Baba, JD.com. JD up by more than 5%.
It's a golden week, and people have money to spend because the government just gave them some. You saw what I did there. Look, this is basically a trade that nobody can come up with a reason to get against. Maybe we would have gotten some words from the Chinese authorities pushing back a little bit against the gains. They love this. So this, to me, raises a question. Have we seen a market shift in the sentiment and the approach of Xi Jinping's administration? Because to me, that's really the crux of this. Have they moved from a less ideological kind of bent to one that is much more driven by economic support?
Investors certainly get what they want at the moment. They got the cut from the Federal Reserve. They're getting the stimulus out of China. Is there more to come from the Federal Reserve? Look out for the likes of rate cut euphoria on Friday if we get a real downside surprise on the jobs report. Yields are up by 3 basis points on a 10-year at the front end of the curve. We're still just south of 360. On a 10-year, 376.38. The estimate for Friday, the median estimate in our survey, 146K. The previous month, 142. If you're looking for unemployment, looking for that to stabilize at 4.2%. And if you're looking for the teaser, the appetizer to all of that, Chairman Powell, a little bit later this afternoon.
Yeah, and to me, it really matters whether those outsized potential cuts could come, even if there is benign news, even if we get the kind of labor market report that a lot of people are expecting? Or does he say we need to now move slowly and really calibrate whether or not we're dealing with truly a slowing economy or one that actually has some strength underneath it? That will make the difference between a turbocharged, extra euphoric, out of your mind, excited kind of market versus one that's tempered between the bulls and the bears.
Brian Weinstein was on a little bit earlier from Morgan Stanley making a case for higher bond yields. That's been a debate of the moment, I think. Easing out of China, easing out of America, the backdrop for growth in the States, arguably still okay, based on the very sort of top-line, headline jobs numbers we've been getting. And ultimately, we've had people ask, why aren't bond yields higher?
And a big reason why is because a lot of people are kind of straddling this idea of the Torsten Slok, as Anne-Marie mentioned, kind of point that maybe we have a much stronger economy with a higher neutral rate versus the people like Andrew Hollenhorst of Citigroup, who's calling for a 70,000 payrolls print, and potential downside risk, the idea that we're far away from neutral. So it's the Austin Goolsbys of the world versus the Torsten Sloks of this world. And we're smack dab in the middle trying to figure out which way we're going to swing.
With a 10-year at 376. Under surveillance this morning, the U.S. urging Israel to avoid a wider regional war as it steps up air assaults in Lebanon. The U.S. sending more troops to the region and putting more forces on standby.
And they're preparing for potentially an Iranian response would be, you know, individuals I'm talking to, you know, on this side and outside the United States, potentially expecting the worst that it could be is back to what happened in April when Iran sent that barrage of missiles over Israel. But you'll talk to some U.S. officials and they'll say what Israel has able to do, basically put Hezbollah on its back, and within 10 days pretty much decimate rank and file all the way to the top up with Nasrallah dead, and Iran coming out and not looking for that regional war, looking to de-escalate at this moment. Some U.S. officials will say Israel would not be able to do this without the cover of the U.S. in the region, and it sounds like the United States is going to be sending more.
I love that the U.S. is saying, Israel, pump the brakes. Don't do too much. Please, show restraint. Israel does something, show a little bit more restraint. We're going to try to, rein you in. And then they do this, and Israel's like, I don't know, keep going. I mean, basically, that's basically the tone that has been out there. You take a step back, you wonder, this is the beginning of a new phase of something. What is that? What are we looking for? If Iran's not going to respond, does this mean more nuclear acceleration in terms of the production in Iran? Does it mean, potentially rebuilding some of these proxies? It's not over, and yet people are looking at this as a movie almost unfolding, even though there is a lot of very real consequences that are both potentially transformative.
I'm pleased you're drilling down on this particular dimension because I think it's important. Where does it leave Iranian strategy now? Where does it leave them?
Well, it's very challenging for Iran. Hezbollah was the crown jewel, as Jumana mentioned earlier, of the axis of resistance in the region, and Hezbollah has been decimated. Of course, there's still individuals there, but between the pagers, which hit rank and file, and then I'm still trying to work out if the pagers were a precursor that Nasrallah had to convene all of the top brass to come out and speak in person because they were so worried about their technology being tracked, and then they were able to hit him. Iran is basically left with a lot of questions on how are they going to work within this regime. And to Norm's point, there's a question of whether or not this pushes them more towards nuclear acceleration or pulls them back.
Lisa talked about the movie. There are going to be plenty of books written on the developments of the last few weeks, that's for sure. Lisa also mentioned this story a few times this morning. It's one of the biggest developments in this country in the last few days. Floodwaters threatening more damage in the aftermath of Hurricane Helene. The storm killing at least 84 people after making landfall in Florida and stretching across the nation's south. AccuWeather estimating the total damage maybe somewhere between 95 and 110 billion dollars.
We've seen this before in terms of flooding being the real damage, and the flooding is continuing, sort of akin to what we have seen in the past. We also have a lot of reports of people who are missing. I'm just wondering, how do you deal with this with a Congress that's not in session and with people who are making politics of this on both sides? How do you end up dealing with a very real, humanitarian issue of getting people rescued and back in their homes and fortifying some of the essential infrastructure, but also longer term, how do you prevent against this at a time when it's going to require some real investment?
Well, we hear from the president today. He's going to be speaking about this. And over the weekend, he was speaking to Governor Kemp, Republican of Georgia, Governor Cooper, Democrat of North Carolina, about what the federal government can do immediately. Your point on Congress, very well taken, but that kind of funding will be very acute. Do they even know what to fund in that sense? The most needed funding right now will be coming from the federal government, and Biden has pretty much said, we're here, we'll give you what you need.
The president will be focused on this event as well. East and Gulf Coast ports are preparing for a shutdown as Labour talks stall before a contract deadline later on today. The International Longshoremen's Association will post an updated statement on Facebook. President Biden saying he won't intervene in any strike, telling reporters that resolving the dispute is a matter for collective bargaining. Bloomberg's Danny Berger joins us from a shipping port in Newark, New Jersey. Danny, how close are we to this strike?
About 16 and a half hours, John. By all indications, with no talks scheduled, with the White House not intervening, the strike will go on unless something remarkable changes. So at 12:01 a.m. on Tuesday, as the head of the Longshoremen's Association put it, a sleeping giant will be awakened. This is some half of trade that comes into the U.S. that the ports will be affected, 36 in total, all along the East Coast and the Gulf. The two main sticking points, they want a significant wage and benefits increase, some 80% over the next 6 years. The current offer up, the Longshoremen's Association has called it stingy. stingy. The other big sticking point is automation. They want significant language written into the contract to prevent automation that we see in the ports of Asia, that we see in Amsterdam. They do not want that for fear of jobs lost. Now, they have significant leverage at this time, more than they have in some time, considering it is administration friendly to labor. And there's a supply-demand issue. There are not enough people to do these jobs. So it is leverage, which ironically is part of the reason that these employers want to put automation in the first place.
And of course, the other point of that leverage is this administration definitely does not want to see a spike in inflation before November 5th. Danny, can you give us a sense of what the timeline is now for these talks?
Well, so the contract expires at midnight. So we, again, are just talking hours away from that kind of thing. But there are no scheduled negotiations. Everything we know about what's been offered, that's been happening behind closed doors, too. Has not been made public. From what we understand, the White House has been trying to act as a mediator. But again, this is happening behind closed doors. The timing does get tricky because even if these ports are just shut down for a few days, that has ramifications that last weeks. By some measures, just one day of shut ports will take a week to clear out. So days turns into weeks. If it is a week-long strike, it means months. And that's when you start running into the issue of the holidays. Sure, some of these retailers have been stocking up, but places like small businesses don't have the capacity to hold up inventory. So again, this needs to be resolved in just a few days in order to not have a bigger economic impact.
Do we have a sense, Danny, of how many protections have sort of been baked in, whether it's maybe rerouting maybe some of these ships to the West Coast ports or delaying some shipments given the stockpiles and just hoping that things get resolved in 3 weeks' time?
Well, so ports like where I am here in Newark, the head of the port workers here has been calling before to get things sped up. They've basically elongated hours heading in today in hopes that they would be able to do it. But that can only get you so far. You were just talking about Helene, especially with the southern ports. There have been a lot of trucks who've been unable to traverse the south of America because of the hurricane, meaning it's been harder to kind of speed things up, get ahead of this. When it comes to the West Coast ports, there is an idea of solidarity. The head of the Longshoremen Association has said that the West Coast ports will not cooperate with diverted shipments. So that's not so much of a probability. And also HSBC says that they can only handle some 17% of the cargo coming over. Canada, the Port of Montreal, is also dealing with its own strike. So Lisa, in terms of alternatives, there are not a lot right now.
Danny, appreciate the update. Plenty more from Danny throughout the day on Bloomberg TV and on Bloomberg Radio. To continue the conversation, Lee Klasko of Bloomberg Intelligence joins us now for more. Lee, I want to stay on Lisa's line of questioning. We saw some tremendous volume going through West Coast ports through the summer. How much preparation was done ahead of time for the potential of this playing out?
Well, I think the ports were ready, and they also had the capacity to handle more freight. I think more sophisticated shippers have been ahead of this looming port strike, which has been well telegraphed for quite some time. What we could see, from our perspective, because, we cover a lot of transportation companies, this could be a net benefit to a lot of the trucking companies and intermodal providers out there, because this should boost rates. Rates for the trucking market and intermodal market have been pretty depressed over the last 2 years. And so this could be, the final shock to the system that could move rates higher, which would be a net positive for trucking companies and intermodal providers like J.B. Hunt or Knight-Swift or Hub Group.
Lee, how long can this go on before some of these workers that might be on strike lose a lot of leverage, whether it's financially for themselves or whether it's just in terms of the public zeitgeist for their actions?
Yeah, I mean, for them, for the fatigue that might happen from a strike as a prolonged strike, these folks really aren't getting paid when they're not working, and they also have their own bills to pay. So, as this goes on, it could weaken their resolve to be striking. We are expecting a strike. We don't expect a strike to last more than a couple of weeks. We think that if it goes on beyond a week, the federal government will step in because of the impact that it will have on the economy. The good news is a lot of the economic impact is really going to be delayed versus lost. Some of that will be lost. But the numbers that you hear, whether it's $5 or $6 billion a day, really isn't lost and gone into the ether world. It'll come back. It'll just be delayed as the ports kind of either work through the congestion that could be created in the West Coast or the congestion that's going to be created in the East and Gulf Coast when the ports start going back to work.
Lee, over the weekend, President Biden said that he doesn't believe in Taft-Hartley, but you think the federal government will get involved. How will they do it?
I think they probably might have to enact that. I mean, that's just, our view. Just given the, economic impact. I mean, we are an election year. As you know, GDP growth is not great. It's tepid at best. And we want to keep that GDP growth positive. The longer this goes on, the more it could impact that GDP growth. And again, whether it's short term, that those numbers do matter, not only to all of us here, that cover the markets, but people in Washington as well.
Lee, let's say he does go forward with that and activates an 80-day cooling off period. How much work would actually get done on the East Coast ports?
That's a great point. They will probably be working not at full speed, but there will be throughput at the ports. That throughput will be very limited. From what we understand, the two parties are very far apart on pay. From what we understand, they're also, the union does not want any further automation, which could be a huge sticking point because ports want to be more efficient. I think what the workers and the unions might want to focus on the new jobs that might be created through these automation processes. There might not be someone working a crane, but it's the people that are fixing the equipment that that could be creating new jobs on the port.
Lee, you mentioned they're far apart. How far apart? What's one asking for, and what's the other offering?
I don't have intimate knowledge of it, but from what I've seen in various reports in the press, they're looking for a $10 an hour raise, and the port's kind of like half that. So they're pretty far apart. The Eastern port workers, for whatever reason, from an hourly basis, make less than their West Coast counterparts. And I think the East Coast port workers are looking to get to parity to the West Coast. I don't know if it's an apples to apples comparison, but that's the stuff that I've seen out there. In the earlier report, they talked about the union is in a good position to be negotiating. Obviously, they are. We're coming up on the busiest time for freight as freight comes in ahead of the holidays. And it's very important for retailers to have, goods on the shelves when customers come in and want to buy it. So it's very important, and that's why the ripple effect will be felt. You could see more air freight. We haven't really seen much air freight movement be diverted from the ocean yet, but we could see that. You're going to see a lot more truck movements as freight needs to be expedited. So net, from if you cover the freight, transportation, logistic companies, it's going to be a positive, obviously a negative for the economy, a negative for the port workers, and negative for shippers as well, because they're going to be paying higher freight rates.
And a tough month for the president, potentially as well. Lee Klasko there of Bloomberg Intelligence. Biden between a rock and a hard place.
Well, he said over the weekend he's not going to, or he doesn't believe in Taft-Hartley, but then we just heard from Lee there that this is potentially what the government's going to have to do. So I already in my mind am thinking what the Trump campaign is going to put out as a last-minute campaign ad when they want to go for the rank-and-file union workers. President Biden, I don't believe in Taft-Hartley. President Biden, right before the election, I'm going to have to enact Taft-Hartley because we have to get these workers back.
Good news for Biden. He's not running for a second term anymore. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. DirecTV and Dish agreeing to a deal that will create the largest pay TV provider in the U.S. Under the terms, DirecTV will acquire Dish from EchoStar for $1 while assuming $9.75 billion in Dish debt. The deal is dependent on Dish bondholders agreeing to take a haircut on the principal amount by about $1.5 billion. The two sides expect to close the deal in the fourth quarter of next year, pending regulatory approvals. Turning to the silver screen, The Wild Robot premiered at the top of the domestic box office this weekend. The movie, based on Peter Brown's best-selling books, brought in a better-than-expected $35 million in ticket sales. And second was Warner Brothers' Beetlejuice, which has grossed more than $250 million in 4 weeks. Paramount's Transformers 1 came in third place. And the moon has some company. An asteroid the size of a 33-foot school bus is trapped in Earth's orbit for the next 2 months. Astronomers in South Africa first spotted the asteroid, named 2024 PT5, in August. The mini-moon is expected to circle the Earth for 57 days without completing a full orbit. It won't be visible without the use of a relatively large research-grade telescope, according to the astronomers. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, navigating U.S.-China tensions.
We're exporting American technology, which is really terrific for the United States, that the world is built on American standards. NVIDIA is an American company, and our government and the administration would love to see us succeed.
Mandeep Singh of Bloomberg Intelligence, up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Stock market just a little bit softer stateside. We're down by 0.3%. Bond yields just a little bit higher, up 2 basis points. The 10-year, 376.76. Under surveillance this morning, navigating U.S.-China tensions.
Well, we have to defer all of the policy making to the administration. We're exporting American technology, which is really terrific for the United States, that the world is built on American standards. NVIDIA is an American company, and our government and the administration would love to see us succeed.
So here's the latest. NVIDIA getting squeezed from both sides. Bloomberg reporting Chinese regulators are discouraging companies from purchasing NVIDIA's H20 chips used for developing and operating AI models. The move is meant to boost China's domestic chip makers. NVIDIA also facing domestic pressures amid an antitrust probe. Bloomberg's Mandeep Singh joins us now for more. Mandeep, can we get into the word discouraging? What does that mean in practice?
I mean, basically, the government is telling them to be more self-sufficient in terms of, their use of chips required for training these large language models, and they would rather have them use a Huawei or, a domestic chip maker for training these chips, because everyone realizes that, for these scaling laws to play out, and everyone believes, the next large language model will be bigger, you need bigger clusters. And that's where I think the government sees that this is a long super cycle. I mean, you just can't be reliant on an NVIDIA and spending, billions of dollars in CapEx on technology that's not homegrown. And I think that's the message here.
Mandeep, the West has been trying to restrict NVIDIA's exports into China already. I just wonder how that's really sort of hurt the company going forward anyway. Does this make a big difference to them?
It does, and I think the export controls here seem to be working for the government, not so much for NVIDIA, who had, almost a 20% revenue exposure to the China market. So that revenue exposure is declining, and I mean, all this suggests that it will be an even lower portion of their overall revenue growth. So clearly, for a company that is growing exponentially, everyone expects them to keep doing that kind of, maintain that kind of growth run rate. This is one less market for them to sell to. And remember, the largest internet companies after the hyperscalers here are in China. I mean, your ByteDance, your Alibaba, these are the companies that are training their own large language models. So if NVIDIA can't sell to them, I think they have fewer buyers for their chips, albeit, these are some of the largest hyperscalers here, but clearly I think in the long term, it affects their growth rate.
Definitely the long-term trajectory looks like China is going to urge potentially even more for these companies to stay away. But when you look at these companies, what can they get that is so similar to that semiconductor that NVIDIA is selling?
Look, I mean, the best proof point we have is what Huawei smartphones have done. And what you have seen is Huawei shipping those smartphones. There has been some domestic adoption to the point that they have taken share from Apple. And similarly, you could argue, if Huawei can create a chip for the smartphone market, why can't they create a good chip for the server data center market? And I think the bet here is with all the subsidies that Huawei units are getting from the government, and with their own foundry, SMIC, in China, they should be able to catch up. I mean, they're not going to have a TSMC latest chip that NVIDIA is making, but they should be able to get closer over time. And given this is a multi-year bet, the government wants these companies to focus on it right now and, plan for the future.
Mandeep, on the flip side, how much is the U.S. actually restraining development and innovation, given either antitrust issues as well as some of the regulation on large language models?
Well, I mean, I look at it this way. There are open source versions of large language models that are released by Meta. So open source is available to all. And, for companies that are domiciled in China, they know what they need to do in terms of catching up, to the latest models that are being released by OpenAI or by Google that are closed source. So I think when it comes to regulations, yes, you can prevent China from getting access to the chips, but what if they're able to get access to the latest ASML machines, the EUV machines from the foundry side? So there are all these different aspects where the geopolitical tensions come into play. And I feel the export controls on the chip side are working because the H20 chips that NVIDIA is shipping, clearly it will hit a wall in terms of scaling. And if the government is not allowing the next version of the chip to be given to the Chinese companies, I think it will have an impact on their LLM training process and the scaling that I mentioned before.
Mandeep, it was good to get you on. Mandeep Singh there of Bloomberg Intelligence. The last week with regards to China, not a moment for nuance. This whole market worldwide just ripped on that story. Now it's a moment for nuance. It's not going to benefit everyone. Autos, biggest loser on a stock 600 over in Europe today.
There is a lot of divergence that's happened between now and before the pandemic between the U.S. and China, and we're going to see that come to the fore.
Up next in the third hour of Bloomberg Surveillance, we'll catch up with Venu Krishna of Barclays, Sheila Kaolu of Jefferies, Aditya Bave of Bank of America Securities, and Kathy Jones of Charles Schwab. The third hour of Bloomberg Surveillance, up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The employment data is really important.
The Fed gets it. They understand that employment risks are actually going up.
I don't think that the economy is going to do as well as the market is pricing in. I think it's getting a little bit over its skis.
There is an excitement about rate cuts and the opportunities that they bring, but there's also this trepidation that what if that 50 basis point cut was a crisis cut?
All the data from now until November are going to decide whether the Fed goes 50 or 25.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bound 90 minutes away. Equity futures backing away just a little bit. We're down by 0.25% on the S&P 500, but still very close to all-time highs after a third week of gains in last week's session. If you look at the equity market story this morning, futures just softer by a third. On the Nasdaq 100 down a half. On the Russell of small caps negative 0.7%. Nothing like what we saw out of China overnight once again. A gain of more than 8%. The story stateside looks like this week. Payrolls on Friday, looking for something in at around 140K. Don't forget this, Chairman Powell this afternoon. Powell speaks. We'll all be listening.
If he says, I like 50, 50 is a great number, let's go again and again, and honestly, we're still doing okay, so this is just a matter of us being really far away from neutral. Can you imagine? Talk about, hey, Xi Jinping, pass the beer. I mean, this is going to be a real kind of juicing of some of the euphoria that you've heard. If you hear moderation, that's going to be more interesting because it is a lot harder to get excited about a negative read on this labor market on Friday.
When it comes to potential moderation, you're talking about 140 penciled in, rounded about. Take that in half is what you mentioned also last week from Citigroup's Andrew Hollenhorst. He's looking for 70,000 on Friday's print, but reiterating the fact I think many market participants say, which is nothing matters more between now and the Fed, and that's NFP.
We get a 70 on Friday. I don't think it matters what Chairman Powell says this afternoon. 70 is far more important than going another 50 on November 7th.
Yeah, this is Mike Wilson's point over at Morgan Stanley, that essentially what happens with equities right now really does hinge on just the health of the labor market. Don't forget, some of these lesser indicators are actually very important. We get JOLTS tomorrow.
Sure.
We get ADP, jobless claims, like you were mentioning. How much do people take the idea of just a less good environment as being more negative than it is positive because it will be met with outsized Fed rate cuts? This, to me, is the ultimate question. Is this the week where the pivot point of negative data is very negative for equity markets that are basically hinged on the economy growing faster than people are currently pricing in?
Are we looking for a hint of Goolsby a little bit later this afternoon?
If we get a hint of Goolsby, how much do equities rally?
I think this market goes up and to the right pretty quickly if you get a hint of Goolsby. Equity futures right now down and to the right. We're negative by about 0.2% on the S&P 500. Yields are higher by 2 basis points. The 10-year 3.77. Coming up this hour, Vinu Krishna of Barclays on Beijing's stimulus boost. We'll speak to Sheila Kahyaoglu of Jefferies as Boeing labour talks remain stalled, and Aditya Bave of Bank of America Securities previewing the payrolls report. We begin this hour looking ahead to remarks from Fed Chair Jay Powell this afternoon and Friday's jobs report after stimulus from China boosted sentiment worldwide, helping to send Chinese stocks into a bull market. But Vinu Krishna of Barclays is staying cautious, saying we would note that despite upbeat sentiment in financial markets, our macro research colleagues believe that impacts to China's real economy are likely to be limited. Vinu joins us now for more. Vinu, it's good to see you.
Good to see you.
Are you not buying the happy talk out of China in the last week?
I think in the short term, all these measures could work, given how negative the positioning has been in the sentiment. But I think the issue with China is much bigger. It's structural, demographics, the property market, consumer sentiment, a host of things, domestic consumption, right? Which is you can't export your way out forever, which is what they're trying even now. So I think that is the question. So I think in the short term, it's tough because the questions of what, is it a gun or is it a bazooka or whatever, right? So you fine, you bring your bazooka and that. But structurally, over the longer term, what changes?
How would you describe the move over the last week? Is that just shorts coming off, new longs going on, a positioning squeeze that turns into a bit of a mount up in the short term? What would you call this?
I would say it's a combination. It's a big relief as well, because so far the concern has been that in the past, they've thrown in a huge amount of stimulus. They weren't doing it this time. And so the concern was that they don't care as much. But now the opinion is that they do care. And now they're saying that this is very important and they're going to do something about it, right? So I think it's a combination of all those. And perhaps it has some staying power. But I take a step back and say, just like the US economy, the reason you're optimistic is structurally there are a lot of things different in the US. It's not the same in China. So when you put all those facts together, I think it's a wait and see.
So you said that there are some structural things in the U.S. that are good. So you're bullish on the U.S.
Yes, I'm still bullish on the U.S., though I'm a little concerned at the pace at which we are going ahead. I think it looks too fast, too soon. But structurally, for example, the U.S. remains at the forefront of the technology front, unparalleled. We are still one of the world's biggest economy, right? We are the world's biggest oil producer now. And we still are at the center, or probably the leader of the global financial architecture. And the dollar still remains a reserve currency, unlikely to change. So I think when you start putting all that together, mainly I would say even tech, because the secular shift in the markets right now is around technology. And the shift in technology, if you take a step back, is not something which is new. It's been going on for about 3 to 4 decades now, from the PC cycle to the internet to mobile devices. We were in the middle of a cloud transition, and then you got AI on top of that. And at the center of it is the action is coming from the US. And the ecosystem we have in the US, mainly around the Valley, is unparalleled and cannot be replicated just by infusing capital.
That's a great story. Yeah. You expect losses by the year end. How much short term do you expect this story to have been overplayed and basically everything to really face a whole lot of volatility based on potential growth headwinds, potential regulation, potential geopolitics, the election?
Absolutely. You raised a lot of right points, and that's why, if you see, my base case price target is 5,600. We're already above that. But we do have an upside case of 6,100, and in all fairness, a downside case of close to 5,000. So I think the way to think about it is big tech has corrected reasonably healthily. Multiples which had gone to about 34 times are now back to about 29 times. So just about the threshold where we feel comfortable. I think anything in the mid-20s to 29 in the range is reasonable because their growth is decelerating. So they are comping the comp. In other words, now they are looking at 60% plus growth rate to sort of match against in the coming quarters. And the expectation is that their growth will decelerate to around the 20% range. So pretty healthy. You're paying a PEG ratio of 1.3, 1.4, which is quite full, but it's not broken. But for the rest of S&P, the comps get easier. So you had bad numbers. Now the street expectation is it goes up 15, 16%. I'm skeptical. I think it's going to be less than that. But still, directionally, what's happened is the composition of growth has changed. So big tech still leading, but moderating, reasonably priced. And the rest of the S&P, quite fully valued, I would argue, but growing at, expected to grow, in my view, maybe around 10-ish%, which is not a bad combination. It leaves me to your question that what about the levels right now? I think we probably need to take a little bit of a breather. And I don't know what the catalyst is going to be. Maybe it's elections, maybe it's some geopolitical event, but we haven't cared about geopolitics forever. So I'm not too sure why we'll start caring now.
You have such a big gap when it comes to the upside and the downside.
Yeah.
And you say, you don't know the catalyst for what could be. Is there a potential of what the catalyst, though, would be to the upside if you're unclear about what it would be in terms of taking a breather?
Sure. I think the catalysts are very clear. You talked about the jobs numbers just now. So the big shift in sentiment over the last, call it, month or 2 months has been this growth scare, right? And so based on historical experiences, the market is very concerned, and we are, that is the labor market as robust as it seems? Is it a fact that labor market can decelerate very quickly? We don't know. We don't think so. But the point is, it is very clear that the odds of even a shallow recession have increased over the last 2 months. They haven't decreased, right? So that is your case, downside case. If you start suddenly seeing a deterioration in the labor market, which nobody is expecting, including us, but it is a real possibility because the odds have increased, you could start testing the downside. On the other hand, we are still printing very robust numbers. You saw the Atlanta GDP number. It came even stronger. Consumer sentiment marginally increasing. So I think if growth does accelerate, and there's a reasonable likelihood, even though that's come down a little bit, there you have my upside case of 6,100. So I think, it all depends. And the derivatives market is telling you that the one thing they care about is the NFPs, right? So, that's where the action is.
So good news is good news still. That doesn't change.
Yes. Right now, the good news is good news. We've shifted from that paradox of flipping it back. But I think the question is good news till something breaks, right? And so the disconnect right now is between the rates market and the equity market, right? And what I would suggest is that the rates market has been all over the map for the last 2 years. We're expecting 7 cuts, then 0, now 9 cuts by the end of middle of next year. So the equity market has been more right than wrong, right? And so that's an interesting situation we are in, right?
You throwing some shade at your colleagues on the other side of the room, that the bond market's been all over the place. Did you hear that? I heard that.
I heard that. So, basically, is that your accusation?
Well, my point is that everybody looks at the rates market as a big barometer of what to expect.
Smart money in
right?
the room, yeah.
So which is true, but my point is if you tried to follow that, you'd have gone crazy because you wouldn't know what to do a week from week, right?
Okay.
It's flipping.
All right, hold on a second. In fairness, so not to defend the bond market, but to defend the bond market, equities have had, S&P 500 has had 5 straight months of gains if we close out the month of September with a gain. It has come in tandem with 2-year yields having 5 straight months of yields going down. You're saying that isn't directly correlated?
Well, what you really care about for equities is the 10-year rates, right? And if you look at 10-year rates, where are they moving around? But that is a discount factor because we're a long duration asset, right? And we were hovering around 5% a few months ago. right? And then we went to 3.5%. Now you're again going back towards the 4% range. So I'm not trying to sort of reduce the importance of the rate market. It is very, very important because it is discount rate just factors in.
He's trying to bring back his bond market colleagues. Carry on. Come on, keep going.
But at the end of the day, you know, it's been all over the map. And let me tell you something. So everybody in the macro market is concerned about deficits, right? So you would expect that shows up in the term premium. Where is it?
Some big egos on that side of the room, as you know. Venu, thank you. Venu Krishna of Barclays. They would say justifiably so.
Well, yeah, they would say, look, the bond market has lost some of its preeminence when it comes to predictive power. You worry about the deficit, you whine about the deficit. Why aren't you responding with higher yields? It's something a lot of people have mentioned. Just wait. That's what Brian Weinstein says.
Your yields are up today. You're 10 years up by 2. You're 2 years up by close to 5. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with those devastating floodwaters threatening more damage in Georgia and South Carolina in the aftermath of Hurricane Helene. The Category 4 storm that came ashore Friday killed at least 84 people and left millions without power. AccuWeather estimates the storm may be one of the costliest in U.S. history, with damages totaling anywhere from $95 billion to $110 billion. Meanwhile, vice presidential candidates Tim Walz and J.D. Vance will take the spotlight tomorrow night in a debate on CBS. They will stand behind podiums in front of 2 moderators, but with no studio audience. Vance has been prepping with Republican Congressman Tom Emmer of Minnesota, while Transportation Secretary and one-time presidential hopeful himself, Pete Buttigieg, has been holding mock debates with Walz as part of his preparations. And Ford is increasing its efforts to boost electrical vehicle sales. Starting tomorrow, the automaker will offer free home chargers and cover the cost of installation for customers who purchase its EVs. The promotion will be available for the Mustang Mach-E, the F-150 Lightning pickup truck, and the E-Transit cargo van. The deal aims to ease range anxiety felt by many mainstream buyers. That's your Bloomberg Brief. John?
It's a tough, super competitive market for the likes of Ford and others as well. This just dropped from Peter Cheer over at Academy, and it speaks to what we've been talking about through the last few hours on this program. This time, the benefits from Chinese stimulus would accrue much more to China and its companies than to the US and its companies. This does not lift all boats. There's been a real preference shift from the Chinese consumer to domestic brands.
How much is the knee-jerk reaction by investors that a rising China will lift all boats globally? And how much is that incorrect based on some of the structural shifts over the past few years? And I think that is what Peter Scheer is trying to get at.
Check out European equities this morning. Tough. Stellantis getting absolutely hammered, cut its outlook. VW cuts its outlook for a second time in 3 months. Up next on the program, the Morning Calls Plus, Sheila Kahyaoglu of Jefferies as Boeing labor talks remain at a standstill. That's next. This is Bloomberg.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
The open in about 1 hour and about 13 minutes away. Equity futures pulling back by 0.2% on the S&P 500. Let's get you some morning calls. First up, Barclays downgrading Procter & Gamble to equal weight, expecting slower growth due to weakening sales in China. Next up, Morgan Stanley downgrading JP Morgan to equal weight, saying the bank is among the worst positioned for rate cuts. That stock is down by 1% in the pre-market. Those earnings just a few Fridays away. And finally, TD Cowen raising its price target on Southwest to 25, citing ambitious 2027 targets announced during Investor Day. Stay tuned for more on that. That stock is up by 0.2%. Sticking with travel, the Boeing strike continuing into the third week. Sheila Kahlu of Jefferies recently cutting her price target on the plane maker to 240 from 270, but maintaining a buy rating, expecting an early October end to the strike and resetting expectations for a smoother ramp through 2026. Sheila joins us now for more, with the stock down another 1%. Sheila, good morning to you.
Morning.
Why the price target cut first, and why the base case still to get a resolution to this in early October?
Early October means about a month, so we're 18 days in, so we would expect some sort of resolution in the next week and a half or so. The reason for that is they've missed one paycheck last Thursday. I think you start feeling it when you miss the second paycheck. Remember, the workers on strike are not earning anything at all. They get about a $150 gift card starting this week in week 3. So we'll see. They're sticking to it, though, and we're seeing strikes elsewhere, obviously, as well.
They're asking for what, and what's being offered?
So we don't know what they're asking for, but they're getting a 30% pay raise. They want some pension benefits in there. They have the bonus back in, which was a sticking point in the original offer. So they want... You know, we're unclear as to what the IAM is focused on in terms of the increase, but they want more than 30% over the next few years.
We've been struggling to understand whether this is the last gasp of labor having leverage, or whether this is actually an ongoing kind of theme that we're seeing with respect to leverage, given what we're seeing also with the ports. What's your sense with why now, and how much momentum is behind these particular strikes?
I think why now is a lot of the labor force might have changed its demographics since the pandemic. You might have a younger workforce that isn't as attuned to its employer, and maybe that's why. I mean, with Textron in Wichita, we're seeing a strike, same IAM machinist union group. We're seeing that they put out a very decent offer for the first proposal that they had. They had everything the group wanted, and it was an 84% vote down. So we're seeing that across, aerospace and obviously the ports as well. And it could just be the momentum, but I think at some point reality hits when you don't have that first month of pay, the second month of pay. I mean, it has to hurt.
At a certain point, the bull case for Boeing has to be that the U.S. can't let it fail. That basically this is not a company that is optional for the United States. What's your sort of thesis behind having a lower price target but also a buy rating?
In terms of the strike, I think the case is after 6 weeks, it becomes a moot point, because even if you get a 40% raise, which is the highest we've seen in the sector, and that's Air Canada, which you could say is arguably in Canada, so it's a little bit of different employer base, it becomes a moot point because you lose 6 weeks of pay, and even if you get a 40% increase, you're breaking even over that time period. Of course, you have a higher base to go off of, but I find it hard to strike post that 6-week mark, 6.5-week mark. We cut our estimates by 15%, and it was solely based on production coming in lower. We're expecting about 400 aircraft this year, 600 deliveries next year. That's across their entire group, so 737s, MAXs, and we're not including $1.3 billion of free cash flow usage in our base case assumptions of $240 yet per month for the strike, as well as any sort of equity raise, which we think is certainly on the table.
Given how important Boeing is to the U.S. industrial base, likely why you have this buy rating still in the company, do you expect the U.S. government to get more involved if the talks drag on more than a month?
Yeah, the buy rating is solely based on execution of the backlog, and we continue to push out our numbers, whether it's 25, 26, 27, getting that free cash flow base case. Management's working actively. It doesn't seem like the government is intervening in any sort of way, aside from a federal mediator. That's about as aggressive as it's gotten. We've heard no mention from the administration in terms of Boeing, where a Trump administration was much more involved and heavy-handed.
But this company is still too important to fail.
Of course. I mean, we don't have deliveries of aircraft. It impacts schedules. It impacts the aftermarket. And that's really been our main call, has been long aftermarket names. We just put out a very bullish note on this company called FTAI, GE, HEICO, TransDigm. Every 100 planes that aren't delivered is 5% upside to the aftermarket names at minimum. And so you keep those planes sitting there for longer, you extend the life of these existing aircraft, and it's a bullish sign for those older planes and who's servicing those.
This is Boeing. Can we talk about Southwest?
Of course.
I mentioned that call from TD Cowen. They've raised their price target. They're citing ambitious 2027 targets around Investor Day. You've still got to sell on this name. They call it ambitious. What do you call it?
Yeah, it's a very non-consensus call to have a sell rating on Southwest. I just can't bridge the $4 billion of incremental, EBITDA. But this stock is not going to trade on near-term numbers over the short term. That's very clear. Because if it was, it'd be much higher than that. I mean, I think the company's break even this year. To get an incremental $4 billion in 2027 is robust by any company, let alone an airline, which is extremely volatile.
You've got your doubts. How big is this push into premium right now?
It's interesting. Their premium is extra legroom, essentially 3 inches. I mean, at 5 feet, 3 inches does absolutely nothing for me. But for some, they might pay a 70% premium on the airfare, which is what Southwest didn't give us, that 70%, but that's essentially what it's embedding to hit their $4 billion incremental EBIT target, is that they're going to get essentially 2x the fare for 3 inches of extra legroom versus the existing seat. I mean, I find that hard to believe, but maybe it's all the Boeing workers that are striking that are going to pay that. I'm unclear as to who's willing.
It's like glamping, but I just wonder how much this is just essentially an oversaturated market, especially if you're trying to make incremental changes that include, breathing space and maybe having your bags with you.
I mean, the best part about Southwest's interior, when we got to sit in it last week, was the fact that they have power plugs. Southwest did not have power plugs, so as a corporate customer, they totally missed out on that customer base. I mean, they were behind the curve, let's face it. So this retrofit, by the way, they're expecting to do all 700 aircraft in the next 12 months. I mean, that is, given the tightness in the aftermarket and the maintenance shops that we're seeing, I find that hard to believe. But kudos to them for laying out a strategy. I'll buy some of that $4 billion, but definitely not the 100%, and maybe not even 50% there.
Sheila, appreciate it.
There's
your view on Southwest. Kind of brutal, I've got to say. Sheila Kohli there of Jefferies. This is a very crowded push into the premium space.
Yeah, and how premium is premium? I mean, it sort of raises this question, right? Is it 3 inches? Is it that you actually get a drink? Is it that you get to carry a carry-on? I mean, it's sort of like basic power outlet. You basically take enough things away, and then you can add them back for a charge, which has essentially been the model of modern airplanes.
How basic, a power outlet.
I agree. There's still some planes that don't have power outlets.
Well, I just wonder, there's this pitch toward people who are going on vacation and sort of the girls' trip out, and you want to add, some niceties. But there's a question about whether those niceties are 3 inches of legroom versus,
nicety. A power outage is basic.
Power. Well, some of us can't always fly in the jet stream like Anne-Marie.
Is she flying in the Gulf Stream?
Yeah, she's doing
Gulf Stream. Doing?
Yeah, exactly.
Oh,
yeah.
Good for you.
Only on the weekends.
Coming up next on the programme, Aditya Bava of Bank of America Securities and Kathy Jones of Charles Schwab, counting you down to an address from Chairman Powell later on this afternoon and payrolls on Friday. The opening bell 1 hour away, equity futures negative 0.2%.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
60 minutes out from the opening bell. Here are the scores for you. The price action looks like this. Equity futures negative across the board here on the S&P 500 near session lows. We're down 0.25%. On the Nasdaq 100, we're down around about a third. 1 hour away from the cash open. Let's get you some morning movers. We can do that with Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. Stellantis, what do they own in America? Why are we starting with that? Down 13%. Dodge, Jeep, Ram, and Chrysler. This company is going from cash flow positive to cash flow negative of nearly $6 billion. They're lowering production and they're going to use more incentives. Now, the issue is this: clear the inventory off our lots. That is the message from the U.S. sellers here. They wrote an open letter to the CEO. You're degrading our brands here in the United States of America. You're on course for disaster in the U.S. Now, this bleeds through to GM. Have a look, roll it over. VW warned this morning as well. They're hemorrhaging market share. You got it. BYD, electric vehicles in China. GM had that downgrade last week. We talked about it. Morgan Stanley downgrading it to underweight. Again, the bleed through from Stellantis across the auto sector here in the United States of America this morning. That ever-important growth of EV in China, and everybody else pretty much bungling it. NVIDIA, down again this morning, day two. We're looking at a near 5% drop in this stock price over the trading of 2 days. Why? A message from China. Do not expose yourself to NVIDIA's H20 chips. The first half of this year, NVIDIA's exposure to China was $6 billion. That's 11% of their income. I couldn't squeeze in Aston Martin. Stock is down 25%. Maybe the second-hand market will give me my DB7. Jonathan.
Cross my fingers for you, Manus. That stock looks ugly. We're down and down hard for Aston Martin. Let's talk about the automakers. We've said this repeatedly on this program. This is probably the most competitive market on the planet anywhere. Chinese autos. These companies are working tremendously hard just to stand still in China and not go backwards. We're talking about a bigger pie off the back of some stimulus in China. We need to talk about a smaller and smaller slice going to international players outside of China.
Which is what Peter Scheer was talking about from Academy Securities, that essentially this is a new China on some levels, with domestic consumption being prioritized over international imports. So you start to wonder, even if there is that boost, what will it do to the Stellantises of the world, even the BMWs of the world that rely on Chinese exports, but at the same time are finding it very difficult to compete with some of the national champions?
BMW, Mercedes last week up something like 8%. This morning, just a reality check across Europe. Stellantis, VW, Aston Martin. Just a brutal morning for European autos.
And it raises this question: how much can they continue to lean into their China presence versus at the expense of some higher walls to Chinese vehicles coming into Europe? Because that has been one of the biggest toggles that they've had to really face off with. How do they do that at a time where they already are underwater and need to find levers to pull to try to gain profitability?
European stocks not participating in that big run-up on the CSI 300 over in China today. The CSI 300 up by more than 8%, and equity futures aren't participating either. We're down by 0.2% on the S&P. Markets looking ahead to the week's biggest catalysts and including today's remarks from Fed Chair Jay Powell ahead of September payrolls on Friday. Aditya Bave of Bank of America Securities expecting a print of 150,000, with unemployment holding steady at 4.2%. Aditya's with us in the studio here in New York. Aditya, good morning to you, sir.
Good morning. Thanks for having me.
Thank you for being here. We've heard from consumers. They say jobs aren't as plentiful. They're getting harder to get. Are we going to see that in job openings this week?
It's certainly a possibility. So if you look at the JOLTS report, this will, of course, be for August rather than September. But if you look at the recent JOLTS data, that job openings number has been dropping like a stone. And that's not sustainable. At some point, that's not going to be benign, right? It's going to start affecting the labor market. So that's something we're watching quite carefully. The openings rate now looks quite consistent with where it was before the pandemic. So further sharp decreases in openings will be a point of concern.
There's a missing feature in the bearish narrative. It's layoffs. Yep. What's happening with layoffs? Where are we?
Layoffs are still very low. And that's the reason that we're holding on to our soft landing outlook. If you look at the layoff rate, that's been low. If you look at jobless claims, that's been low as well. And even within the unemployment data, you can look at kind of voluntary versus involuntary unemployment, where involuntary would be layoffs, right? So that only accounts for a little more than half of the increase in the unemployment rate. So no matter how you slice it, layoffs have been low, and that gives us more confidence about a soft landing.
Also revisions, and this is sort of counterintuitive, because some people are saying the revisions to jobless claims and to the jobs figures have been downward, and significantly so. But the revisions to GDP and GDI were the opposite direction and suggested quite a bit more growth in the couple of years in the direct aftermath of the pandemic. How much are you looking at that and saying, we need to rethink the strength of the economy?
Oh, absolutely. Those revisions were remarkable. So there was a big gap between GDP and GDI going into the revisions, with GDI being significantly softer. So the bearish view on that was that eventually GDP would get revised to GDI because income is more easily measured or something like that. But actually what happened was that GDP got revised up, GDI got revised up even more, and it's now basically caught up to GDP. So across the board, you look at the components of income and compensation, for example, got revised up a lot. You look at the components of GDP, consumer spending, CapEx got revised up. So these were very positive revisions, and I think there's two potential implications, right? The first one is that productivity growth has really picked up more than we expected. The other is, look, eventually there's going to be a relationship between activity and the labor market. And which way will it go? Will activity backstop the labor market, which is now looking like a bigger risk given the revisions? Or will activity collapse under the weight of a softening labor market, and now that's looking less likely?
Okay, so this to me brings me to sort of the paradox that we're dealing with right now in markets, which is you've got two tail risks that are diametrically opposed. Brian Weinstein earlier this morning really highlighted that, and he said people are underestimating the growth in this economy and overestimating how low the neutral rate is. It actually is going to be much higher than the Fed says, and that really they don't have as long of a way to get to neutral. Do you agree, based on some of these revisions and the amount of momentum that there seemed to be in the economy heading out of the pandemic?
Sure. So to the extent that productivity growth has really picked up, very mechanically, that does mean a higher neutral rate. I think eventually we'll know the neutral rate when we get there. So
that's
we're
not
probably
good enough.
not.
Come on, give us advance notice.
It's probably higher than it was before the pandemic. Chair Powell said that as well. The question is it high twos? Before the pandemic, it was low twos, right? So is it high twos, is it mid threes, or is it even closer to 4%? And I think all we can honestly say about the neutral rate is that it's somewhere between 2.5 and 4, and we'll know when we get there.
Aditya, can we ask about what's potentially going to happen in the next few hours? We know what's going to happen. There's going to be strikes at ports. What could be the impact on the economy?
So there's two things that we focus on when we think about the impact of strikes on economic activity. The first one is that the longer they last, the more of a drag they are, but not in a linear sense, but rather in a non-linear sense at some point, because then they start to affect supply chains, right? So a 1 or 2 week strike is pretty painless, right? The other thing is that because GDP is a flow variable, whatever impact they have usually gets paid back the following quarter when the strikes end. So it'll be a temporary impact. It'll show up. It won't show up in claims because when you're striking, you can't apply for jobless claims, but it will show up in employment.
So what's the cutoff when it actually can become more damaging down the line?
It really depends on how many people are striking, how broad the strikes are. So there's no fixed sort of cut off, right? But when we were thinking about the auto strikes last year, for example, we were thinking, once you go beyond 4 to 6 weeks, it gets a lot more painful.
So how much do I need to strip out from Friday's number? Do I need to strike adjust this number?
Not really, no, because the survey period was the week of September 12th.
Do I need to cut off 60 because of revisions?
You need to account for the fact that Chair Powell is cutting off something, right? He didn't say what, maybe it's 40 to 60, but this I thought was really interesting in his press conference. What he said was, we are mentally adjusting down the jobs data that we get, right? So there was a question about whether the downward revisions from the QCW, which ended as of this March, would extend to April and beyond. And he's saying that the Fed is working on the assumptions that they will, which is quite dovish, right? Because if you're trending around 120, 130, you could easily just idiosyncratically get a soft number around 60, 70, 80, and then Powell's thinking of that as being very close to zero. So that actually makes a pretty strong case for another 50 from our perspective.
So I'm going to take a line from markets philosopher Jonathan Farrow, who's talking about the whiff of Goolsby. If we hear the whiff of Goolsby at 1:55 p.m. today from Jerome Powell, how much does that risk a reacceleration in the market with a series of 50 basis point rate cuts that reignite the growth side of the equation?
It's a risk. The question is, how many 50s can Powell pull off, right? So if you look at the dot plot and you take it at face value, which I would recommend you don't do, but if you did, then it would say that they're not going to do any more 50s, right? We think they'll do one more, but each one that Powell pushes through, we now have a strong sense that he's more dovish than the rest of the committee. It's going to be harder. They're going to face more resistance, because each one you do, you're telling the markets that we're not going to stop, and you're getting closer to neutral, so maybe you don't want to do too many. So our base case is one more 50 and then back to 25s, but honestly, everything's on the table for this Fed. You could get to 25s if the jobs data are good. You could get very, very fast cuts if the jobs data deteriorate further.
What are you focused on this afternoon? Just a final question. What are you looking for from the Federal Reserve Chair?
I think he's going to be pretty non-committal. There's 2 more jobs reports before the next meeting. He really, really wants to keep his options open, so it's going to be data dependence. He probably used the word recalibration again, which again for us, if you're recalibrating, why only do that one extra 25 basis point increment, right? You want to do at least one more. But he's probably going to talk about recalibration, and he's going to mix this very optimistic message about the economy with a more dovish message around, we'll do what it takes to accommodate the labor market.
2 payrolls report, I think 1 CPI report, and a presidential election in between the next decision.
Yeah, it's going to be really tricky. You got to imagine that if he lays the groundwork now for, we're going to dove, that will just, take away a lot of the uncertainty and the potential
accusations. Imagine if he actually spoke like that. We're going to dove. Aditya, it's good to see you. Aditya Bharve of Bank of America. That would change things up a bit. Kathy Jones joins us now from Charles Schwab. Kathy, your call has been, not for him saying that, but for the lower yields in the bond market. Kathy, are you still committed to that call that yields can edge lower from here?
Well, I think they edge lower. I think much of the move has already taken place, particularly as further out the curve you go. So we're looking for a bull steepening. That is, yields moving lower, but much more at the short end than intermediate or long term. We had a 375, 380 target for the 10-year. We're here. We're just sort of churning around. So I need to see a catalyst for yields to move significantly lower from here.
Kathy, how strong do you think the case is for higher yields, given what China started to talk about in the past week?
Yeah, I don't really put much stock in that. I think that we have a high bar for much higher yields. I think you'd need much more inflation activity to think about. You'd need a significant shift in the FX market to show significantly weaker dollar. I'm really not putting a lot of stock in that. We hear a lot of noise about it, but it never really materializes.
I have to say, Kathy, there were shots fired by Vinu Krishna earlier this morning when he was saying basically the bond market, you can't pay attention to them because they're all over the place. And they say they're worried about the deficit, but they never actually do anything about it with respect to demanding higher yields. And they say that you could potentially have the risk of higher growth, but guess what? They bounce all over the place. Do you think that he's right?
Well, it's been a volatile year. There have been a lot of shifts in the market. I would argue the bond market really doesn't care about the deficit. It certainly doesn't display any concern about the deficit. And yeah, you don't see a big term premium in there. And we really haven't in the past because the deficits haven't mattered. Now, maybe someday they will, but they haven't mattered for the U.S. So I think the problem in the bond market is we've had a lot of mixed economic data. We've had a Fed that was data dependent and therefore not giving, huge forward guidance to go off of. Forward guidance is great when you're cutting to zero and there's a crisis. It's very clear. Forward guidance doesn't really help you when the economy is just kind of rolling along, which is where we are. So I would say he's partially right that the bond market's been all over the place, but I don't know that it's an irrational all over the place. It's just reflecting the data as they come in.
There is a feeling, and this might be the anxiety underpinning some of the recent jiggles that we've seen in longer-term yields, and actually something that you reflected in your recent notes, that there is this risk case for higher yields on the long end than even you expect based on tariffs and immigration. What about accelerating growth or the prospect that we might not have as far to go to get to neutral as Chair Powell is saying?
Yeah, everybody talks about the neutral rate. No one's ever seen it. So I think you have to take all of that with a grain of salt. It'll move all over the place depending on the economic circumstances. But I think the risk to the upside from imposing, say, big tariffs, which gives us a one-time increase in inflation, and probably weakens confidence in the U.S. in terms of policy, that would be a concern. It may have a counter effect of actually slowing the economy at the same time. So it could be quite a bit of volatility associated with that. And I do think one reason longer yields are not really moving very much is partly the economy is doing fine and there's no reason for them to crater. But also, there's a lot of uncertainty about policy. When we get back in January, maybe we'll know some more when we know the composition of Congress. But there's a huge amount of questions about where we're going in terms of policy.
At 1:55 this afternoon, the Federal Reserve Chair, as you know, Kathy, is speaking at a conference in Nashville. There is a Q&A, as Lisa indicated a little bit earlier this morning. Kathy, are there any blind spots left? We've heard from so many Fed officials in the last week. What's left to discuss?
Yeah, it's hard to imagine he's going to tread any new ground in this speech. I think he'll probably be very clear that things are going well. We do have a great soft landing scenario right now. He'll probably warn about some of the risks ahead and say that the Fed's attentive to those. So I don't think he's going to go off the road here in terms of what the exit strategy might be. Are you going to speed up and take the fast lane? Are you going to slow down from here? I think it's going to be more of the same, because why argue with things when they're going well?
It seems like people aren't really expecting much from this week. I've heard from Brian Weinstein earlier, who said it's going to be boring. We're going to trade in a range until we break out. And we could break out to 550, and we could break down the downside at 325. How much do you expect something to change with NFP, non-farm payrolls on Friday, given the fact that if you get a more negative print, you could start pricing in a very different outcome for both the Fed and for this fictitious thing that no one's ever seen, the neutral rate?
Yeah, well, we are looking for something on the lower end of the range, the consensus range, and I think that is a reflection of the fact that we've had those downward revisions, significant downward revisions, which, they tend to move with the trend, and the trend is slower. So I don't think that 110, 115 is out of the question. It's below consensus. It's not a disaster, but it's below. And I think that could break us out of a range. Obviously, if we got, 160, 170, 180, something like that, that would send yields back up to close to the 4% area, probably on the 10-year. But I don't think we're probably going to see anything too dramatic, probably weaker rather than stronger, which is why our bias is still towards lower yields, just not at the pace that we've seen over the last 6 months or so.
Kathy, appreciate the view, as always. Kathy Jones of Charles Schwab. Kathy, good luck for the trading week. 145 is the estimate in our survey. As Aditya Bharve of Bank of America said just moments ago, I think we're all just sort of mentally adjusting those numbers lower as they come in. I know exactly what you would ask if you had the chance to Chairman Powell later on this afternoon. Investors putting too much weight on articles coming out in the quiet period and whether that complicates your effort to communicate?
Is this the new communication strategy? That basically there are certain people, when you read an article, that's basically Jay Powell ghostwriting it. And is this something that basically is prescriptive for markets? Or do you not like that?
The unofficial 13th member of the FOMC, I think it's a problem. We both think it's a problem.
I think that it changes the narrative for a lot of people. It changes the calculus for what people look to in the quiet period to get some guidance for a Federal Reserve that doesn't shy away from surprises, which is what we just saw.
So if you're at that conference, sort of stick your hand up and, try and get a microphone and ask a question a little bit later on this afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. California Governor Gavin Newsom has vetoed what would have become one of the most comprehensive policies governing the safety of AI in the U.S. The bill to hold AI developers accountable for harm caused by their products drew fierce criticism from some major tech firms who warned it could stall innovation. Newsom says he will consult with experts to develop workable guardrails. Meanwhile, SpaceX has started its mission to bring home 2 astronauts stuck in orbit after technical failures with Boeing's Starliner capsule. SpaceX's Dragon Crew 9 has docked with the International Space Station, carrying an American astronaut and a Russian cosmonaut. The spacecraft had 2 empty seats reserved for NASA astronauts Barry Wilmore and Sunita Williams, who will fill them when they all return to Earth in February. And today is the final day of baseball's regular season, with 3 teams now in the race for 2 National League wildcard spots. The New York Mets and Atlanta Braves will play a doubleheader after last week's games were postponed due to Hurricane Helene. If the Mets and Braves split today's twin bill, both will make the postseason. If either team loses both games, they would be eliminated, and the Arizona Diamondbacks would get the final spot. First pitch for Game 1 of the Mets versus Braves is at 1:10 p.m. Eastern. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Game of the weekend, Alabama, Georgia. Just absolutely, did you watch that?
I did not, but I heard that it was pretty incredible.
Crimson Tide throw away a 28-point lead. Looks like they're going to choke. Then this 17-year-old Ryan Williams, who's a total beast. I mean, how's this guy 17? I have no idea.
Hold on a second. You put Jonathan Farrow in the United States for enough years, and he stops talking about football, the British kind. He starts talking about football, the U.S. college kind. Who this?
College football and the atmosphere around it is the closest thing that we have here to European football.
Okay, is that your take?
That's my take.
So you'll watch college football, but not
very
other
particular
football.
games. SEC football, Alabama, Georgia. I think that's as close as you can come to some kind of like European-type rivalry in international football.
Welcome. That's all I could say.
Thanks for having me. Up next on the program, setting you up for the week ahead. You're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
and scene. Both of them pour freezing cold water over Saturday night's game. And what do they do in the commercial break? They watch the highlights of the last 2 minutes and they're like, oh, wow. Yeah, welcome.
Oh, I'm sorry, I'm busy. I can't respond. This is really good.
What a game. Counting it down to the opening bell this morning, 40 minutes away, something like that. Here's the trading diary for the day and a week ahead. Remarks from Fed Chair Jay Powell coming out at about 2 p.m. Eastern Time. Tuesday, we'll get JOLTS and ISM manufacturing and Nike earnings after the closing bell, plus the first vice presidential debate at 9 p.m. Eastern Time. On Wednesday, ADP private payrolls. Thursday, another round of jobless claims. And on Friday, the main event. It's Payrolls Friday. Bloomberg's Mike McKee's with us in the studio. Mike, good morning.
Good morning. Nice to be here on SportsCenter.
Thank you and welcome. More of that still to come. Let's talk about the chairman of the Federal Reserve coming up a little bit later this afternoon. What's left to know?
You're not going to get a whole lot. I think Aditya put it well when he said he's going to be very flexible because they have a lot of reports coming out between now and their next meeting on November 7th. So I would expect him to say the same things that he's been saying, that the labor market and the inflation numbers are better balanced now, and we're going to focus on the employment side of this for the time being, but we think at this point we're going to keep our options open because we don't know exactly. We're going to be data dependent.
So we were joking that maybe he'll come out and say, we're going to dove, but there is this feeling that maybe he'll come out and say, you know, we're not going to moderate. We're not going to be moderate about this.
We're not going to moderate. I like
We're not going to moderate. And basically,
the invention of verbs here.
Stop calling me out. This is kind of what we noticed from Jackson Hole. Is that what we're getting?
Well, unless you have
Mike, help her out here.
I don't think he'll hawk either. Unless you have some data that tells you that things are falling apart or things are getting really strong again, then you're not likely to see him do anything more than say we're data dependent and we'll make our decisions when we get there. We just had Mickey Bowman, the Fed governor, who dissented at the last meeting. She's giving a speech now saying that she's still not convinced that they need to do 50 at the next meeting, that we are uncomfortably above the 2% target still, although she doesn't rule it out if the labor market weakens a little bit.
Did you watch the game Saturday?
Unfortunately, I did.
You didn't enjoy
I was on
that?
the wrong side.
It's quite a finish, wasn't it?
It was quite a finish, and it was, as they say, an instant classic.
An instant classic, one of the best. Mike, thank you, sir. Mike McKee on the Federal Reserve, a sprinkle of football, and looking ahead to Chairman Powell and Payrolls Friday. Coming up tomorrow, here's the lineup for you. Peter Chu of Academy Securities, look out for that. Lots of thoughts, very, very unique, original thoughts on what's taking place in China and what won't happen for certain parts of this equity market. We'll catch up with him. We'll also speak to Seema Shah of Principal Asset Management, Lindsay Rosner of Goldman Sachs, and Erin Brown of PIMCO. I'm hoping that Lisa might be able to speak. Stay tuned.
I can speak.
You're going to be all right?
I'm going to be so good.
Is he going to dove a little bit later?
Or is he going to hawk?
Is he going
to moderate?
Stay tuned on Bloomberg TV and Bloomberg Radio for that and a whole lot more. From New York City, have a wonderful trading week. Good luck to all of you. From New York, this was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, we're off to kind of a slow start on this Monday. Red on the boards, 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, investors are bracing for a crucial week ahead. Fed Chair Jay Powell speaks later today, and that's ahead of Friday's all-important jobs report.
Automakers seeing a run of bad news. Stellantis joins Volkswagen and Aston Martin in issuing the latest profit warnings, partly blaming sluggish demand from China.
And this on M&A Monday, DirecTV and Dish agreed to combine in a deal that will create the biggest pay TV provider in the U.S. All that and more coming up, but let's take a look at where markets are trading 30 minutes until the bells ring. As Matt mentioned, not too great on this Monday. Of course, we're coming off of several consecutive weeks of solid gains, seeing some of the steam come out of the market right now, out of that rally right now. Even with that big run in Chinese equities, you're not seeing that good vibe music over there translate into the U.S. market. The S&P 500 currently down about 0.2%. The NASDAQ 100, your big tech names, which have been leading, currently down about 0.3%. And still a little bit of a sell-off in the bond market right now, Matt. You're not seeing that haven rush necessarily. 10-year yields currently up about 3 basis points.
All right, in terms of the runs that we've seen, Mohammed El-Arian, a Bloomberg opinion columnist and the president of Queens College, Cambridge, highlighted this chart here on Twitter, showing the S&P 500 has put up its best first 9 months of the year since 1997. The index is up more than 20% year to date, boosted by the 5th consecutive monthly gain in September. The S&P has gained for 10 of the last 11 months. So we've been doing pretty well so far this year.
Making me smarter this Monday morning, Matthew. Let's take a look under the hood as well here. Stellantis plunging after car makers said its forecast for the year would be lower as it plans to lower production. Just taking a beating now. You have Stellantis down more than 12.7%. You have Ford also down 3.2%, 3.3%. It announced that it will install free home chargers for EV buyers as competition heats up in the auto sector. We'll talk more about that later this hour. Also watching shares of EchoStar Corp up about 0.7%. Remember, DirecTV and Dish, which is owned by EchoStar, have agreed to combine in a deal that will create the biggest pay TV provider in the United States. Interesting, Matt, it has been up more than 15% since Bloomberg had reported that the deal would be happening.
Yeah, very interesting. We're going to continue to talk about those mergers, but right now I want to talk about, or rather takeovers. There's no such thing as a merger. Right now I want to talk about what's going on in China. 6 consecutive days of gains there, and they had a bomb today, 9% up on the CSI 300.
Yeah, best run since 2008 or so. It's been pretty amazing to watch the CSI 300. It's now up over 20% year to date. It's in a bull market. You rewind to just just a week ago, this index was down by more than 4%, or just about. So, I mean, the rate of change here has been just incredible. You're not really seeing it, though, in U.S. equities, and I think a lot of that we can blame on Germany.
I think you also have to ask if it's real or if it's a head fake, because 25%, more than that over a 5-day period. The reality is it's driven by stimulus. The underlying data is weak, as it is in Germany. I think the question is how much of that does that spill over, that weakness abroad, into the United States?
Yeah, Germany having obviously real problems, being the home of 3 automakers, all of whom have their own issues, but really it's Chinese imports and inflation that are the biggest issue there. We're going to talk about Volkswagen, we're going to talk about BMW, we're going to talk about Daimler, as well as Stellantis, which is kind of like an Italian, Dutch, U.S. automaker, French as well, later on in the program. Right now, I want to focus on the U.S. markets with another chart Mohamed El-Erian highlighted on Twitter this weekend. It shows the strength of everything else, the everything else rally, with the equal-weighted S&P outperforming by the most since 2022. With us now is Morgan Stanley's Chief U.S. Equity Strategist and CIO, Mike Wilson. Regarding the non-farm payrolls number due out this Friday, Wilson says we would need to see an upside surprise to drive a sustainable cyclical rotation in the U.S. And I understand that good news would be good news for some parts of the market, but wouldn't we want to see, in some ways, a miss, because then we could get a bigger cut from the Fed in November?
Well, yeah, maybe it comes with a fine line. I mean, the good news is good news until it's not, because then the Fed has to raise rates too much. That was the story before. Now it's bad news is good until it's too bad. So, look, I think there's 3 parts to what happened in the last 2 weeks, okay? First of all, the Fed gave us 50. I think everybody was kind of expecting 25 right up until the last minute, and so it was still an upside surprise. Now, we had written about this. We thought 50 going into the meeting, if they could convey that it was not being done for growth concern reasons, would be a positive. So we got that, checked the box. And I don't think that was a shocker, but it was a positive event. And then we got the China stimulus. But that came in 2 pieces, don't forget, right? It came with a monetary stimulus initially. And I would say most people, including us, were like, well, that's interesting, but that's not going to do much. We need fiscal stimulus. They're in deflation, right? We're not going to get any action in the real economy. So then, of course, the policymakers came in because they listened, and they said, okay, we'll do some fiscal too, and then we got this massive move. So we've had a 20% plus move in 3 days, which I would say very few people captured, all right? The other thing you have to think about, why is it up so much today? Well, Japan sold off sharply over the weekend. So I think, China has been a source of funds for the Japan trade, for the India trade, all the other EM countries that have done well. Okay, and now you may see some reversion back, but that feels pretty overcooked to me at this moment. What we care about in the U.S. is the following. Is this going to change the trajectory of growth in the U.S. in a meaningful way? And the answer really is no. It can maybe get some excitement in things like materials, some of the industrial stocks who have direct leverage to perhaps a China stimulus of some kind. But beyond that, I think we need to see the labor market get better in the U.S., and we need to see the policy changes from the Fed have an impact on consumers.
Let's talk more about the labor market, because clearly a lot of investors are hinging on Friday's report. How much could that move the needle? And if you have a significant miss to the downside, what would that mean for equities?
I mean, for us, the labor market's everything now. And by the way, it's everything for the Fed.
Yeah.
So, this is the $64 trillion question. Did the Fed cut 50 because they are actually worried about the labor trends, which I think they should be paying attention to that? Or are they doing it because, look, inflation's come down and they're too tight to begin with, and so that they're able to, is the Fed cutting because they can or because they need to? So the labor market will tell us the answer to that. And, we've been pretty straightforward about this. If the unemployment rate goes up again, I think that's a clear negative. If the unemployment rate can come down and jobs data is okay without any major revisions, that would be a positive.
That's where I want to go, and you make that point in your recent research that we need no material downside revisions to the prior months. Unfortunately, for the bulls, we've seen that over and over again the past several months of NFP reports. I mean, when it comes to the quality of the data and these big revisions we still are getting, how much can you really trust it?
Well, even Chair Powell said that, right? He talked about the QCEW revisions being so dramatic. This is what you get in a slowdown. You get revisions to the downside. Just like when you have a recovery, all the revisions are to the upside. So this is not abnormal. And let's take a step back. This is what the Fed was going for when they raised rates. Once again, the big question is, can they arrest the downtrend, stabilize, and then see labor markets actually improve next year? We don't know the answer to that. We're going to get 2 labor reports before the next Fed next Fed meeting. We're going to get an election. which, I think is probably slowing hiring in the short term just because there's uncertainty around that. So, yeah, it's going to be an interesting October, no question about it.
You also point out that you say earnings revision breadth is the best proxy for company guidance. And what exactly do you mean by earnings revision breadth? It's a little too much jargon for my mom. Hi, Mom.
Yeah.
And, what do you want to see and what is it telling you?
That's by design, Matt. We have these special terms, that only I know the answer. But no, earnings revision breadth is very clear. So it's the leading indicator for earnings revisions. So when I say earnings revisions, I mean, are earnings going up or down? And revision breadth we look at because that tends to be a leading indicator for whether it's going to be up or down. Revision breadth has been basically flat now for the S&P 500 for quite a while. And for the Russell 2000 and small caps, it's been negative. That explains a lot of why smaller, low-quality companies have underperformed because revision breadth and the earnings revisions subsequently have been poor. So now here's the thing for October. Typically, seasonally, revision breadth is negative going into third quarter earnings. Why? Because fourth quarter estimates are always too high. That's why stocks tend to not trade great in the first half of October. So we'll see if that pattern is, changed. If we get positive revisions in the next 2 weeks, boy, that's going to be a real big positive because that would be going against the seasonal trend. I expect them to be negative. The question is, will the market care? Because that's normal. We'll see. It's going to be, once again, a very idiosyncratic earnings season like it has been the last 2 or 3.
Well, that leads me to the question. We hit 42 record closing highs in the S&P 500 last week, Friday, and to today you have seen a cooling of that upward trajectory. Is there any more upside left in the S&P 500 for the rest of the year once election volatility cools up?
I mean, we wrote about this weekend, quite frankly. I mean, this is our bull case, which is that the amount of policy stimulus, has been tremendous, particularly in the U.S., both fiscal and monetary. And that seems to be somewhat coordinated now, not only in the U.S., but also in China now, and other central banks are cutting rates. So that tends to allow multiples to expand further. I would say 3 weeks ago, myself and most of the clients I speak with were in the camp that we would have a tough 4 or 5 weeks into the election, and then you'd get a strong rally into year end. But I'm starting to think maybe it might be more the opposite. We may stay bid into the election, and then I think we get some disappointment post-election on the idea that fiscal's kind of peaked, right, into the election, and also the Fed then isn't fully priced, and then it comes down to the numbers. Can we continue to deliver the numbers that justify the multiple expansion we've already had?
Well, we're going to talk more about politics and the election in the next block. I want to go back to what you were saying about earnings, though, and the earnings breadth revisions. There was a really interesting note out from Torsten Slok over at Apollo this morning saying that 42% of companies in the Russell 2000 have negative earnings. For the S&P 500, for contrast, those big caps, that number is just 6%. So even with these revisions that you're watching so closely and the idea that maybe the Fed could cut more aggressively from here, I mean, how careful do you have to be about where you're picking your spots?
Absolutely. We talked about this last time I was here. Like, we don't hate all small cap stocks, right? I mean, we hate the Russell because it's a low quality. We don't hate it. We think it's a low quality index, and therefore in this kind of environment, that's not the instrument you really want to be long. That doesn't mean there aren't some wonderful small cap stocks within that. And this has been a very high alpha generating environment for a lot of our clients are doing quite well generating alpha this year because there are some very good longs and there are some very good shorts. And I think that's the way we're continuing to approach it, whether we're talking about small, large cap indices or even within sectors. And there we've been very clear. We want to continue to stay up the quality curve. We're not willing to go down the quality curve. We don't think things are cheap enough. We don't think the Fed is far enough ahead of the curve yet to stimulate interest there. That could change if we see the labor data improve.
All right, Mike Wilson, we are just getting started. Sit tight for a couple minutes. Let's take a quick look at what markets are doing. Of course, 20 minutes to go until the bells ring. You can see on this final trading day of September, which was supposed to be not a great month, we are seeing a little bit of red on the screen. The S&P 500 currently down about 0.2%. Same thing, too, if you take a look at the NASDAQ 100 pre-market. But still, all in all, it's been a pretty good month for equities. The small cap index that we were just talking about, the Russell 2000, currently lower by about 0.5%. Much more with Morgan Stanley's Mike Wilson coming up next. This is Bloomberg.
a number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's get now to high interest to look at what's making headlines around the world. Israel bombed the center of Beirut for the first time in almost a year, with hostilities against Hezbollah escalating after the Israeli military killed the group's chief late last week. Hamas, who is still at war with Israel in Gaza, said the strike killed the head of its Lebanese branch. At least 1,000 people in Lebanon have died since Israel began striking the country in the past couple of weeks. Francis Ford Coppola's $140 million new film, Megalopolis, debuted over the weekend and only brought in $4 million in ticket sales. The Godfather director spent decades on making the avant-garde picture, even selling part of his own vineyard to raise the funds. Ticket buyers gave the film a D+ grade in Cinema Score. It's rare for a big budget movie to get less than a B-. And Vice President Kamala Harris is cutting her West Coast campaign trip short to return to Washington, D.C. for an emergency response meeting to do with the Hurricane Helene. The massive storm has been ripping through the southeast and has been blamed for at least 84 deaths so far.
And for more on all things politics, including what is happening with Helene, we are joined now by Jack Fitzpatrick of Bloomberg Government in Washington. And perhaps you could speak a little bit to how the current president and the vice president are dealing with the hurricane, particularly as we know that Vice President Harris has spoke with North Carolina Governor Roy Cooper to talk about the rescue and recovery efforts in what is a key battleground state.
Yeah, this is tricky because everyone involved, especially in the presidential race, wants to make it clear they are focused on the response to all the damage from this hurricane. But at this point, logistically, you cannot visit the most heavily impacted area, obviously with the roads out around Asheville, North Carolina. So the Vice President Harris, has cut the end of her fundraising trip short on the West Coast and is coming back today in Washington to go to FEMA headquarters to get an update, at least making it clear that she is focused on this. President Biden will speak about it at 10:30 a.m., and former President Trump is visiting Valdosta, Georgia, so in the area of the path of the hurricane, but not in the area that's most heavily affected right now. So it is something that's getting a spotlight in the presidential campaign trail. Again, no one wants to come across as if they're ignoring this, given how severe the damage is. But for real negotiations, real action, it'll probably have to wait. There may be a conversation in December about more funding, but right now it's more a matter of speaking about it, putting a spotlight on it, and making it clear that this is getting everyone's focus.
All right, Jack, really appreciate your reporting, of course. We'll continue to follow this story closely. That is Jack Fitzpatrick of Bloomberg Government in Washington. Meanwhile, we're back now with Morgan Stanley Chief U.S. Equity Strategist and CIO Mike Wilson. And Mike, I want to talk to you about the potential impact of a strike along the ports. Of course, you have union workers along East Coast ports and Gulf port coasts, threatening to strike starting tomorrow, October 1st. And it seems like there is a lot of daylight between the two sides, to put it mildly. So if we were to see a strike, if we were to see a prolonged strike, how much of an economic impact could that have?
I think it's the second part, what you said. It has to be prolonged. I mean, the good news is that inventory levels are still quite high, kind of across the retail channel. So in some ways, it may provide some relief, potentially, that inventories can come down. Maybe there's some extra pricing here as supplies get short. But if it persists beyond a month or so, then it becomes a real constraint, and the costs start to really build up, and then we have a margin pressure. And for the Fed, I mean, the Fed then has to, if, let's say this thing doesn't get negotiated, or it does get negotiated in a way where wage increases are significant, does that factor into 25 or 50 next meeting? So there's a lot of implications here. These are messy situations. I'm not optimistic, unfortunately, that it gets resolved this week. Probably need some more action before the two sides come together. But as I said, I think it's the length of the strike that will then determine the magnitude of the impact.
You're not known for your optimism.
It's not true. Well, I'm generally a half glass full guy, but in this case, I think this is a tough one.
Yeah, well, I was thinking, what impact could this actually have on the markets? And the interesting story, you know, politically and economically. But then I remembered what happened when that Evergreen boat got stuck.
That was amazing.
Yeah, in the Suez Canal. And those supply chain reverberations lasted for more than a year.
Sure.
You know, I mean, Aston Martin right now, its profit warning is because of supply chain problems more than it is China. Do you expect this could be a real problem at that scale?
Well, sure. I mean, we had the port issues during the pandemic where you couldn't get workers to unload the cargo.
Yeah.
So it's just one more example of how fragile some of these supply chains have become pre-pandemic, right? We've gone to this just-in-time inventory system, globalization, and manufacturing goods halfway around the world and then shipping them from there. And so, you know, I think this is part of the bigger question. Like, how are companies thinking about managing inventories, managing production, reshoring, et cetera, going forward? This is just one more example of that. And labor costs has been something that's been a real tailwind for 30 years, and maybe we can't be that confident about that anymore.
Well, as you both point out, I mean, we've been through this before. We've seen this movie before, and the argument is out there that companies maybe are a little bit more flexible in their supply chains, and maybe they know a little bit more how to handle these sort of crises.
Well, here's a question on that note. If you're worried about wages going up being potentially inflationary, if you're worried about inventory shrinking here to the extent that you have to raise prices, then wouldn't both things be inflationary? At the end of the day, do you still worry about the trajectory of inflation when nobody seems to be as worried about it anymore, except maybe if you're Michelle Bowman?
Yeah, I think the inflation situation short term, I feel fairly confident about. But I think if we don't have a further, like, let's say things reaccelerate here because China's stimulus, which is a surprise, we get perhaps, you know, gas prices continue to come lower. That's helpful. And then the Fed gets really ahead of the curve and they start cutting rates again in a way where people feel optimistic. Well, then, yeah, I think then you're going to be back into the other camp. This gets back to our original thesis coming out of the pandemic, which is going to be, we're in sort of these shorter, hotter cycles. We don't have all these tailwinds anymore, these relief valves that we've had for the last 30 years of falling inflation, falling interest rates, falling labor costs, outsourcing of production. And so these are all things that make the supply side of the equation harder to manage. And that creates this boom bust almost in the inflationary cycle. I'm not worried about inflation right now, but I think it's a great question for 2025.
And Mike, just quickly here before we let you go, let's talk a little bit more about the U.S. election. There was an interesting note out from Evercore saying that, well, a century of returns show that united government handily outperforms divided. This time could be different, that in this specific scenario, actually a divided government might be better for markets. And with that in mind and that history that we have here, how closely are you watching the down ballot races?
I mean, I think the congressional election is way more important for markets than the presidential election, okay? And the main reason is because of legislation. I would say that a unified congressional outcome is definitely bad for bond markets, okay? I'm not so sure about stock markets because you'll probably get more stimulus, which is going to be bad for the fiscal situation, but that may be okay for stocks, right? Because the stock market likes growth. The stock market likes inflation. I mean, it's a misunderstood concept, right? People think, oh, inflation is terrible for stocks. Actually, it's not true. When inflation was booming, that's when we had the best breadth in the stock market. That's when the Russell 2000 was doing really well because that's their pricing. That's their nominal GDP growth. That's their nominal revenue growth. So I think, to me, a unified government on the congressional side, you get more stimulus, probably better for stocks than bonds. if rates go up too much, obviously it's not great for stocks.
Mike, great having you, and thanks so much for joining us. Mike Wilson there from Morgan Stanley, U.S. Equities, Chief U.S. Equity Strategist and CIO. Coming up, Ford's new incentives for its EV customers. You're going to see more automakers coming out with price cuts and incentives. Details next in Social Climbers. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Time now for Social Climbers. The company's making waves this morning. And first up, Ford offering free home chargers and installations to customers who buy its EVs in a bid to boost sales. The offer is a new approach to addressing what consumers say is a primary obstacle to purchasing an EV, range anxiety. Next up, Levi Strauss teaming up with Beyonce in a series of ads capitalizing on the buzz generated after the pop icon released a song on her album Cowboy Carter with the denim maker's name. The Levi CEO said that the shout-out was, quote, completely organic. Now, coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Marky Patel from Allspring Global Investments. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards.
so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, you know, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric,
countries.
now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We do see futures pointing lower on the S&P, about 0.2%, about 0.2% down on the NASDAQ as well. But it's still been a pretty sweet month for stocks. We're up almost 2%. It's the 5th consecutive month of gains for the S&P 500, and we're up 20% year to date. So nothing to sneeze at. Here at the New York Stock Exchange, you're going to see ResMed ringing the bell for their 35th anniversary. And down at the NASDAQ market site, our good friends at CNBC ringing the bell. Looks like their 25th year on the NASDAQ market site. Now, in terms of what's happening with stocks this morning, amid a slew of profit warnings from car makers that are in Europe and a bunch of records on stocks that are in China, let's go to Katie Greifeld to ask what's happening on indexes here in the United States of America.
Yeah,
Katie?
all of that is weighing on U.S. equities right now. On the final trading day of September, you can see we're nursing slight losses here on the S&P 500, currently down about 0.2%. Same thing, too, if you take a look at the NASDAQ 100. These aren't big moves. And like you say, Matt, of course, we've had a pretty good month. And you can see that in the Russell 2000 as well, that follow through. The small caps currently off about 0.4% on this September day. Some stocks to watch underneath the surface. Let's talk about shares of Chinese stocks extending their rally on speculation over the government's stimulus plans. The Chinese market has officially entered into bull market territory after a rip-roaring week, a week that really hasn't followed through in U.S. equities, Sonali.
I'm also watching Dish owner EchoStar. It agreed to merge with DirecTV, creating the largest pay TV provider in the United States. The two companies have gone back and forth over a deal for decades, but take a look, Matt. You have EchoStar shares down almost 5% as the market opens. This has been on a tear since we first announced that deal. We'll dig into it more later this hour.
All right, big share drops as well at the automakers, as I said. Stellantis, which owns Chrysler, Jeep, Ram, and Dodge, has lowered its outlook for the year. The automaker was already cutting costs and lowering production targets, citing more competition in the market, and here you see those shares off 12%. Let's take a closer look with Bloomberg Global Autos editor Craig Trudell. So, Craig, you know, it's not just Stellantis. You've had Mercedes out with another warning. We had Ford out with a colossal warning over the summer that just tanked the stock. What's going on in this industry?
Yeah, I mean, it's been kind of left and right in Europe. We've also had Aston Martin today with a pretty ugly profit warning. It's been a clean sweep in Germany with Volkswagen, Mercedes, and BMW just in the last few weeks. But I think what makes Stellantis really unique among these companies is, they have real operational issues in North America. And I suppose you could put Ford in that camp, but Ford was really more so an issue of quality and recalls. With Stellantis, it's an issue of having been stubborn for quite a bit in terms of, keeping pricing elevated and allowing inventories to really get out of hand to the point where, a few weeks back, the dealers did something really unusual and published an open letter criticizing CEO Carlos Tavares. And so, this is in some ways a kind of response that speaks to just the issues that they flagged. They wanted the company to step up and help them clear inventory. That's part of what's happening here is they're slowing production, they're increasing incentive spending because they just have too many cars and trucks on dealer lots.
Yeah, it's amazing when it comes to Stellantis. Also projecting industrial free cash flow will now range from negative 5 billion euro to negative 10 billion euro. The previous guidance had been for positive cash generation. So quite a switcheroo there, Craig. Can we talk about GM a little bit, though? Because that chart we were just showing, all the shares of the automakers not looking too hot. And then you have GM just outperforming everyone. What has GM done this year that has really set it apart from the rest of the pack?
I think they have a fresher lineup to work with, and they have not been without, their mistakes operationally. I think, electric vehicle-wise, and, you look at some of the other more forward-looking bets, including on autonomous vehicles. I think Cruise has had real issues. That being said, the sort of, bread and butter for this company of big pickups and full-size SUVs, that product is both, fresh and strong and appealing to consumers. That is where they're able to price, most and really sort of pad their margins. So are they having some issues that some of the rest of the industry are facing? Absolutely. But Mary Barra does, seem to be sort of, rising above her peers in terms of, the way that they performed this year.
Yeah, I gotta say, I was using Super Cruise this weekend on the highway, and it's just set it and forget it, and it's pretty amazing technology, at least in my limited experience. Craig, thanks so much for joining us. Craig Trudell there, Global Auto Czar, coming to us out of London. I want to get now back to markets with Margie Patel, Senior Portfolio Manager at Allspring Global Investments. And Margie, just on this, the auto industry, obviously, they have their own specific challenges, but they're still facing supply chain issues, as highlighted by Aston Martin. They're facing real challenges, most of the Western automakers in China, and they've got labor issues no matter where you look. How concerning is this, and how much is this an industry that really needs more Fed rate cuts?
No, I don't think Fed rate cuts would really make a material difference. Total cost of financing isn't all that big of a deal for a consumer to buy a car. But when you have an industry that has overcapacity, commoditization, excess regulation, labor rigidity, it's very difficult for companies to have competitive profit margins, and the weaker links tend to be accident prone, as you've listed all these companies that have had different blow-ups, all a little different, but all relating to a slow growth market, too much competition.
Is there anything about the auto market here, Margie, that you could kind of extrapolate into other sectors as well? This idea where, and maybe we've heard it in other places before, you need tremendous CapEx in order to have a payoff here with consumers, by the way, consumers that might be weakening. Where else do you see this story playing out?
No, I think the auto industry is really more unique. It's a general reflection of consumers being a little pinched, their income being decelerated. So to me, it's a natural that you would see that there'd be problems with car demand across the board. But I don't think it translates to other parts of the economy. And here again, if you look at GM, they've had a tremendous performance year to date. They've distinguished themselves among the industry, but still it's been a very, very tough industry over the longer term.
Yeah, GM shares up about 30% year to date. Just breathtaking there. Let's broaden out, though, Margie, and let's reflect a little bit on the month that was, because September has contained multitudes. Of course, the first week of September was the S&P 500's worst week of the year, and then the following week, we were up 4%, best week of 2024. So that kind of volatility that we're seeing on the trend higher, is there anything we can extrapolate out from that for the rest of 2024?
No, I think that was a lot of short-term trading, adjusting. Small caps had a big move. People reacting to the Fed cuts and some of the economic data that showed the labor particularly was a little slow. But I think that what we're likely to see is the economy continue to advance at a very modest level, 1.5% to 2%. We had a great 3% quarter. I actually just reported, but we think the economy will be slower, and so you really have to look at what sectors or what companies are going to have above average growth over the balance of the year. And it really isn't related to interest rates. It's really more what sectors are they in, where's the demand.
Margie, what stocks do you like here? I mean, we're up at 5,700 and change on the S&P. As I've been saying this morning, you know, already up 20% year to date. We have seen kind of a broadening out. It's no longer just the Mag 7 stocks that are doing well, but are there a lot of stocks or a lot of industries out there you think still have a lot of room to run?
I would say moderate room to run. I don't think a lot of room to run. I think the technology sector is still going to be one of the leading sectors of performance balance of the year into next year. Often a more volatile sector, but it's the price you pay to get more return. I think the industrial sector has a lot of dynamics going for it that it hasn't had in previous cycles, long-term growth areas such as electrifying the grid, improving the grid, and incorporating technology, things like that. So I think there's a lot of opportunity there, more on that side rather than the consumer side, which looks as if, to me, will be a little bit muted.
And Margie, I'd love to get your perspective on what we've learned out of China over the past week. Of course, that drip feed of stimulus obviously having an impact on Chinese equities, not seeing it so much when it comes to U.S. equities. And I'm curious how you're thinking about this stimulus and what the best way to invest along it is. Is it just buying Chinese equities? Is it a commodity play? Do you potentially look at European luxury names? How are you thinking about it?
Well, we think U.S. is best, so we don't find China particularly interesting. And it's hard to see, except for the short-term reaction, that can change the long-term trajectory of the Chinese economy, which is for continued decelerating growth. You can't have a country that half of the economy is geared toward capital expenditures and exports, and 18% is geared to real estate, and expect that the economy is going to be vibrant. So we think it's not very interesting. We would rather see companies in the U.S. that don't have a lot of Chinese exposure because we think the growth is going to decelerate, and this is just a kind of a flash in the pan reaction in the market, not a change in their long-term growth characteristics.
Margie, we have to leave it there. Thank you so much for your time this Monday. That is Allspring Senior Portfolio Manager Margie Patel. I want to bring you some breaking news as well. SoftBank's Vision Fund has agreed to invest $500 million into OpenAI's latest funding round, according to the information. And this would value, of course, the developer of ChatGPT at $150 billion before the investment. The deal represents the first investment by SoftBank into the Sam Altman-led company. And remember, it also comes as Thrive Capital is expected to be investing about $1 billion into this round. So SoftBank's investment is about half of that. Tiger, Coatue, Microsoft also participating in the round, according to the information. Now coming up, China stocks extend their rally as investors get FOMO. But can it last? We're going to talk about that next. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that Their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, we have Seaport upgrading Disney to a buy, saying it's positive on the media giant's streaming business. The analysts note that some weakness in the company's theme park business still exists, but says that that's likely temporary. Next up, TD Cowen upgrading Accenture to a buy and raising its price target on the consulting firm. Analysts say that the company's path to recovery is more clear thanks to increased bookings in managed services care. And finally, we have Morgan Stanley saying that JP Morgan is no longer a buy, cutting its rating to the bank on the bank to equal weight following the Fed's interest rate cuts. And analysts also noting that rate reductions are more positive for the mid-cap lenders, Matt.
All right, let's turn to China right now. Chinese stocks extending, as we've been talking about, a remarkable turnaround, soaring for 6 days on the CSI 300. This script says a 9th straight day. Wow. I don't know what index that is. As government stimulus entices investors back to one of the most beaten down markets worldwide. Let's get a look at the Hang Seng China Dragon Index for the past week. Maybe that's the one that's been up 9 days in a row. Joining us at the desk is someone who knows everything about China and emerging markets. Damian Sassower is our Chief Emerging Markets Credit Strategist for Bloomberg Intelligence. I was looking at the CSI.
Shenzhen.
6 straight days of gains exactly in Shenzhen, and 9% today. Yeah. Is this all from the stimulus that we didn't think was a bazooka?
So here's the way I look at it. A 16.3% rise last week alone in the CSI 300. I mean, Matt, that is basically the S&P year to date at 20%. I mean, they did it in a week. So that was by far the best week we've seen ever since inception of the index in 2005. Better than the week we saw back in November of 2008, which was a huge rally after GFC. So look, you know, Chinese equities are acting kind of like a very illiquid sort of asset class would, with light positioning, one that can get pushed around by some big bats. And I think that's what you're seeing here. Certainly the extension into commodities, which is really your mechanism, you know, your transmission mechanism for the currency side of the equation. You see iron ore up also something on the order of what, 10% last week alone. I mean, it was sorry.
I mean, to that end, those are stunning moves.
Yeah.
Is it justified? If you look at the underlying economic data in China, this is stimulus that is propping it up. Can the stimulus last long enough to really outstrip the market here?
Well, I think you have to differentiate from monetary and fiscal stimulus, right? And everybody keeps saying it, but it's very, very true. All we're talking about are pledges, vows, promises from the PBOC and the officials in China that the fiscal stimulus is going to come, and this time is going to be different. But we haven't seen it yet, right? So, I'm unfortunately, I remain suspect. And look, for me, I mean, I'm an emerging market guy, so I have to look at the dollar. And I have to look at dollar yuan, which is a huge cross that impacts most of the emerging market currency complex. And, I look at, on one side, the risk of a hard landing in the U.S., and on the other side, a soft landing in the U.S. where inflation stays sticky. And that runway, that valley of the dollar smile is getting narrower and narrower as we head to the November election. So, you've seen the dollar correct now pretty considerably. And, for me, it's very difficult, and I think the markets are kind of showing you this. It's very difficult to position one way or the other in the dollar. So most of the people that you probably have talked to, Margie at Allspring, they're talking about cross-currency trades. They don't want to touch the dollar, which is unusual given that the dollar is usually 90% of all FX transactions in the $7.5 trillion a day FX market, right? So, so again, I take a step back and I have to look at dollar yuan here, and it looks a little bit stretched here as we push through the psychological 7 handle. And I look at euro dollar, and I think euro dollar is telling us a message that is not entirely true or believable. One that the U.S. growth, the U.S. exceptionalism we've recently witnessed is all but gone, and that Europe is going to basically play catch-up. I don't think so. I think that I'd be a little bit suspect on the euro here.
Okay, Damien, we have less than a minute, and I have 2 questions for you. Number one, which index should we be looking at? When it comes to Chinese equities, I mean, what is the most informative here?
It's not even an index for me. It's going to be BABA, JD.com, Baidu. It's going to be, it's going to be the big techs. Yeah, exactly. Kind of like the Mag 7 here. I mean, they represent such an overwhelmingly big part of emerging market equities writ large. And I think to that point, because you guys are equity guys, I'm a fixed income guy, but I will comment on the fact that you will see crowding out from the Korean and Taiwan semiconductor names because of this move in China, right? You're going to see some position re-weighting. People are going to want to kind of chase this a bit. So, I think some of the other Asian equity markets could suffer off the back of that.
All right, we're up against the clock, so we'll just have to have you back for number 2.
And I'll just quickly correct
Make sure not to wear
myself
such
and say, you know what?
jacket.
The team in the control room was right. I'm looking at
9
now.
days.
It's
I think
9
so,
days in
too.
a row on the Shenzhen, the CSI
Hard
300.
to believe, but it's 9 days.
Yes, 9 times.
Over 9 days. Anyways,
I don't
Damien.
recall him being sick 9 times.
Anyways, Damien Sassower from Bloomberg Intelligence, we thank you so much for all your time, all of your analysis. Now, coming up, we're going to talk about Merger Monday. DirecTV and Dish agreeing to combine in a deal that will create the biggest pay TV provider in the United States. That's next in our Wall Street Beat. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market about 22 minutes into this final trading day of September. You can see actually big tech managing to go green here. The NASDAQ 100 currently up about 0.1%. You take a look at the Russell 2000, also up about 0.1%. Can't say the same when it comes to the S&P 500, currently down about 0.1%, Shonali, but it's very early yet.
And it's time now for the Wall Street Beat, Katie, because today we're going to look at a mega media deal. DirecTV and Dish are agreeing to combine in a deal that will create the largest pay TV provider in the United States. TPG will acquire AT&T's remaining 70% stake in DirecTV for about $7.6 billion. Joining us now, Bloomberg's Crystal C. It's fascinating. Just look at those EchoStar shares today on the heels of this deal. We have reported that this was a deal that in some ways was kind of weeks reported, but also years, decades really in the making. What page does it really turn here?
Yeah, so that's right. This deal has been it's been considered in the past 2 decades, and if you think about how much that the habits of watching TV has changed, this is really showing in this particular transaction. When it was tried last time, they were not confident that this would get the regulatory green light, given you're combining 2 very big paid TV provider. But if you look about today, most people watch TV on Netflix, on Hulu. Like, you're going straight to the content provider, and you really are looking at 2 very big company that are hemorrhaging subscribers, and you're prolonging kind of the inevitable and seeing how people are going directly to the consumer, directly to the source of the content.
It's interesting. This deal apparently will give fresh funding for a 5G build out to EchoStar, but you look at EchoStar shares, the decline is just quickening today, now down almost 17%. Bloomberg Intelligence says EchoStar is sidestepping bankruptcy by selling off these pay TV units, Matt.
Right. I mean, it's funny when we talk about a mega deal, because these companies are just fractions of what they used to be, right? They're going to have combined fewer than 20 million subscribers, and each of them had that in the past. So are there really going to be any antitrust concerns? I mean, does anyone really care about such a small part of the market?
They had that before, but now it really depends on who you consider to be a competitor. The subscribers number that you just mentioned, it's a fraction of what Amazon Prime has, what Netflix has, what HBO Max have. I think what they're really banking on here is what they call the skinny bundle, where you have a very concentrated bundle of genre, where you only want to watch sports, you only want to watch entertainment, reality TV. So you're kind of banking on that consumer will still pay a smaller price tag, but still remain a subscriber of these businesses.
Can we talk about the economics of this deal just quickly? Under the terms of the transaction, DirecTV will acquire Dish for a nominal consideration of $1, a single dollar, and will assume almost $10 billion of Dish debt. Is that a trade that I can make? Just pay $1 for $10 billion of debt?
You can try that if you have the stomach for it. And they've launched an exchange this morning, so kind of attracting the Dish shareholder to become a DirecTV shareholder. And this is actually a very complicated transaction, and TPG came in as well, kind of providing $2 billion worth of immediate financing just to bridge that current gap. And so really, this is the pricing that we're looking. It really is a price tag of the bond value more so than the amount paid in equity check.
A lot of scuffle over that bond market value over the last couple of months, but also TPG only bought Angelo Gordon really a matter of the last couple of years, so buying that gave it the ability to do this. So private credit matters, once again, Matt.
Yeah, no, for sure. We are all watching it very closely. Crystal, thanks so much for joining us. Crystal C there talking about the $1 deal, the $1 mega deal combining Dish and DirecTV. By the way, that's what Mortimer and Randolph Duke bet.
What?
Trading Places.
Oh.
You've seen?
Oh.
This is a
Trading
reference
Places?
that I'm not going to get, so
Okay.
let's move along.
Someone has. Coming up in the next hour, we're going to talk to the CEO of Mountain, discussing the timeline for his company's potential IPO. Then, National Tree Company's CEO talks about the looming port strike and the impact on the economy. National Tree makes Christmas trees and also Halloween trees.
Halloween trees. If we have time, I definitely want to ask how much of those he actually sells.
I want a purple one. This is Bloomberg.
Archer's laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube as well. Alex Steele and Paul Sweeney with you. Lots going on in the marketplace. A little bit of red on the screen here. We're taking a look at what's happening in China, taking a look at what's happening here on the East Coast, potential strike there. So we'll have a lot of reporting on that East Coast strike coming up immediately. Jerry Kudzel, Generalist Portfolio Manager in Fixed Income at TCW. We'll get his latest thoughts on these markets. They've been pretty conservative there in their outlook on the fixed income space. We'll get the latest there. Geetha Ranganathan, she's going to join us. We finally got some consolidation in the satellite TV business. I've been calling for that for years. Got nothing out of it, but finally it looks like they're going to get together, Dish and DirecTV, so we'll talk to Geetha all about that. But first, let's kick this whole thing off with Mr. John Tucker on our Bloomberg Business Flash.
All right, Paul, the market drivers report being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. Major stock averages mixed a little change. Investors, it appears to be at this point, waiting for the next big piece of economic data. We're going to get the jobs report on Friday. Takes on added importance as inflation is increasingly less of a concern for the policymakers at this point. Ford Motor and General Motors dragging on the S&P 500 after profit warnings from their European counterparts. You had Stellantis with its warning. Those shares, the ADR, down right now 13% in the early going. In China, the CSI 300 index jumping as much as 9.1%, the most since 2008. It was fueled by the stimulus package there. Of Verizon Communications, the biggest wireless carrier in the U.S., agreeing to sell thousands of mobile phone towers to digital infrastructure firm Vertical Bridge. DirecTV and Dish, they also have agreed to combine on a deal that will create the biggest pay TV provider in the U.S., and we'll probably get some historical perspective from somebody in this room.
This literally is like the best thing to happen to this show on a Monday that Paul's been out
He
for
tried
a week.
and he tried. He told the government years and years ago, this is what the landscape, how it's going to change. Did they listen to him? No, they didn't. S&P 500 down 6 points. The Dow Jones Industrial Average 147 points lower. And right now, the NASDAQ 100 11 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul, welcome back. Alex, hi.
Hi, good morning. Happy Monday. I'm Alex
Monday.
Steele alongside John Tucker, and Paul Sweeney is back. He looks rested. He looks happy. These are different things that I'm used to seeing by 10 a.m. On a Monday. I know we're going to talk about Dish for a while, but I mean, this is like a near and dear transaction to you, isn't it?
Well, you know, a lot of media folks, media telecom bankers for 20 years have been arguing that these two companies should get together because we just saw the cord-cutting handwriting on the wall. And these are companies that rely totally exclusively on video distribution. They don't have the broadband that the cable companies and the telephone companies have that can balance it out. So this was an industry that was really just imploding upon itself. And they waited till both of these companies are on life support to let them merge.
Well, also then the regulatory hurdles will be a lot less since they're both on that life support.
And then we got some TPG group is going to come in and buy out and so TPG, a private equity company, is going to own this entire industry now. So because they're going to buy out the other 70% of DirecTV that they don't own. So that's where it should be. That's where dying businesses go, is to private equity. They have great cash flow margins. They can pay off the debt and leverage some equity value. So we'll see. That's how.
So that all kind of in that way makes
And if
sense?
you look at the first place I looked on this announcement was who was getting paid. Every investment bank, every law firm who's ever pitched this deal is getting paid.
Seriously?
Yeah, it's everybody.
Where's your cut, man?
Yeah, exactly.
You pitched
Where's
this
my
a while
cut?
ago.
Exactly.
All right, well, it's Monday. You're looking at a little bit of heaviness in the, well, not heaviness, you know, you're just kind of muddling along a little bit. But it's the last day of the third quarter. You know what outperformed, guys? SPW, equal weighted index, and also the Russell 2000 outperformed the mid caps and as well as the S&P for the quarter as we go. So interesting. And then we get the
Somebody
last quarter
told me
of the year.
last week there was a collar on the S&P 500.
You know who that guy was?
Yeah, he was very smart. I can't remember his name.
I think his name was Vince Signorella. And luckily, he's also here. So the idea is that once you get past today,
is debatable.
it's true. The collar goes away, and then we can kind of flex some muscles within the S&P and have more of a range. That's the ongoing theory. Vince Signorella, Bloomberg macro strategist, sorry about that, joins us now to discuss that. So let's go to that collar, that 5750, which is the ideas. That's why we're not really going anywhere on the S&P. Come tomorrow, are we off to the races then, or what?
Well, I mean, the collar's gone. So which way we race is going to be up to data, maybe what Mr. Powell says later on today. But we're here at a support level right now, which is held for a few days as well, around this 5730. And we've just seen a bid for the Dow taking back about 100 points from the lows. So we'll see if the S&P holds up as well. And once this thing goes away, the new trend will begin. I will note of caution, though, we're not going to get any more guidance from China. It's the beginning of a golden week, so their stock market's going to be closed for a week. Really interesting where we go in the next week and what that does to China's stock market. So if you're invested in China's stock market right now, you've got a lot of risk on your hands that you might want to look to hedge, because if we should turn, for instance, in the U.S. market and we take down the Asian markets, China's got a long way to go.
What do you make of that news out of China, Vince? Are you buying into it, or is this kind of some window dressing? It seems like they've gone a little bit further than maybe the market was discounting.
I buy it in the short term. These things tend to last for about 2 months. And China stimulus is good for about 2 months, and then it turns. I think their problems are much, much deeper than we realize, and that we're allowed to see, for instance, in particular the real estate market. And, you know, you can bring a horse to water. I mean, just lowering mortgage rates isn't going to entice people to buy into a real estate market if they simply just can't or won't, don't have any interest in it.
Yeah, but here's my thing with that, is it enough to have funds and other shops have to right-size some positions, since Chinese equities are so unloved? And if you have to right-size some positions, then you get margin calls, and you got to cover some shorts, and that's going to move a lot of stuff around different assets and different markets, regardless of the fundamentals.
Totally. I mean, it usually gives it a definite good, and that's what we're seeing. We're seeing a nice kick in the short end. but the reality is it tends not to last. So if you're in it for the short run, make some money, get some profit, but don't stick around because it almost always turns, and within 2 months we always end up back on the downside.
So, all right, so lower interest rates environment here. When you talk to traders, what's the trade here for the next 3 months or so for, I don't know, stocks, bonds, currencies?
I mean, everybody's buying into the, lower for longer theory. Me personally, I would show a little caution. We're starting to see an increase in commodity prices from the middle of the month. That's not going to show up in the October numbers per se because it's just beginning in September. But if that trend continues, it's going to be a little bit difficult for the Fed to stay on course. They still have a dual mandate. Inflation isn't beat. We heard Bowman this morning saying she notes that core inflation is still well above the 2% target. I think in the long run, it's going to be really, really difficult for the Fed to hit that 2% target with the deficit that we're running and the way we're spending money in Washington. And we've also got today being the almost guaranteed that the East Coast ports go on strike. So in the short term, not to probably have too much of an effect. Retailers have definitely boosted inventories in anticipation of this. But if this goes on for a while, we're going to see the same kind of supply issues we had with the West Coast strike. And that could jack up prices in the near term, and, not long lasting. We'll use the word transient inflation, but it still would put the Fed on its heels and something they have to pay attention to.
Yeah, and then we also have to look at the growth impact as well. I think it was J.P. Morgan was talking about potentially $3.8 billion to $4.5 billion a day because of the port strike. All right, Vince, thanks a lot. We appreciate it. Vincent Signorella joining us, Bloomberg macro strategist. So let's get to this story. Danny Berger, Bloomberg television anchor, joins us now. She is at the Port Newark Elizabeth in Newark, New Jersey. So she's on the ground. She's been talking to the people. Walk us through, Danny, what's the scene there? Set the scene for us. What's it like?
So we are at this point just some 16 hours away from a potential strike. The next update we're waiting for is the International Longshoremen. They're set to release an update at 11 a.m. New York time on the current status of the strike. But by all accounts, it will be going forward at 12:01 a.m. on Tuesday. That's when the current contract expires. There are no scheduled talks until then. So it seems like we're unlikely to get an agreement. The two major sticking points, one is about wages and benefits. They want some 80% increase in pay over the next 6 years. They say what's currently on offer is, quote, stingy. They also want language in the new contract that prevents further automation of these ports. Automation, I should say, that is really prevalent in other places like Amsterdam and Asia. It's pretty standard, but they don't want it here because they don't want the jobs removed. They have a pretty strong hand to play at the moment. They have an administration in the Biden administration that's very friendly to labor. And they also have a supply-demand issue. There's not enough people who want these jobs, which, of course, is part of the reason that the workers here, the employers, want to automate these ports.
So what's the expectation here? It doesn't seem to be any emergency feeling that they need to get something done here. Is there a sense that this could be a long potential strike here?
Most of the people that I've been speaking to think that this will just last a couple days, really just because there is so much pressure. There is so much money at stake. Not to mention, as I said, this is a friendly administration to them. If they stretch this out and it gets closer to the November election, what happens if they realize that the next administration coming in won't be as friendly to them? Now, a lot of companies, a lot of retailers have been trying to stock up in anticipation of this. So if it just lasts a couple days, the thinking is that most people could go around it. But if it does last longer than a couple days, it takes time. Ships will kind of build up on the ports around me, like you see, and they need to offload it. So something that lasts, let's say, a week, it could end up taking months to resolve itself. There's also not a lot of other options for ships to go to. The West Coast ports, Canada, they can't handle the same amount of volume and really absorb everything that's supposed to be happening here on these East Coast ports.
All right, Danny, thanks a lot. Really appreciate it. Danny Berger joining us there on the port strike. She joins us from Port Newark Elizabeth over in Newark, New Jersey. Let's get more analysis with Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, joining us on this. Hey, Lee, what can be rerouted? What can't? And how does this all work?
These are great questions. So
what can be rerouted are things that shippers needed to have the foresight to reroute a couple months ago. So if a ship is going to expected to hit the East Coast ports, it's not so easy for it to find another port of call to find because there's schedules that these ships have to adhere to. So the more sophisticated shippers probably have been plans in place that are currently, bringing freight to the West Coast or maybe East Coast in Canada. And we're seeing that. We're seeing that in the really huge volumes in imports at LA Long Beach last month. So we're seeing that it's happening now. Obviously, if there is a strike, and it appears that there's going to be a strike, and there's high value, time sensitive freight that needs to get somewhere on the East Coast, there's always air freight. We haven't seen that much movement into air freight right now. It's really just being diverted to other ports where they can come in. And once they come from the West Coast, they either can get trucked across the country or they can put it on trains through intermodal. And this is actually a net positive for a lot of companies that I cover. So I cover companies like Union Pacific and JB Hunt and Werner and Knight Swift. These are all companies that will probably benefit from this in the short term because it really should provide a boost to spot rates in the market. And a lot of this business is going to go in the spot market.
Lee, how about some of the shipping companies and logistics companies that you cover? What are they saying from their perspective about how much pain they're willing to take, how much flexibility they're willing to have in these negotiations?
Well, Maersk, mentioned that they're going to, put out a surcharge for the additional costs that they're going to face. So they're looking to pass on any additional costs that they might have, whether it's their ships waiting by the ports and to unload, or whatever those additional costs might be. So they're hedging themselves. But it really seems like the two sides are really far apart. From what I've been able to glean, it seems like the raise that the port workers want, the ports are about 50% below what they're looking for. So there's a lot of middle ground that has to be made. And we do expect a strike to happen. But like a lot of the people that have been speaking before me, a strike probably won't last that long. And if it lasts more than a week or two, call it, I think the federal government will definitely step in with the Taft-Hadley Act.
Right, which basically says that they can get involved and restrict the activities and power of labor unions when it winds up upsetting the country, basically, and they can't sort of function as a whole. So to this point then, if we get something, let's just say 50 to 70% wage increases over 6 years, what does that look like for the companies that would be involved for that?
So I don't cover the port operators themselves. I cover Maersk, which has some port operations. I mean, it will just mean that their costs are rising. Right now, those are pretty good businesses. I think the more interesting thing from my perspective is the union's inability to accept the reality of automation. Obviously, they want to protect jobs, but in a world of AI, and productivity improvements, whether that's, in offices or on docks, there's really a lot to be said there. And it would be a shame that, the U.S. ports wouldn't be as competitive to other ports around the world.
All right, Lee, thanks so much for joining us. Always appreciate getting your time. Lee Klaskow, he's the Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. He follows everything, the rails, the trucks, the sea ships, all that kind of stuff, logistics companies. So he's our supply chain expert. He joins us from BI down in Princeton, New Jersey. The news of the day that's really kind of gotten my attention, I've been rereading, keeping read in on it, is these auto companies really having a tough time. Stellantis stock getting slammed, as John Tucker's been reporting. And it just goes to the issue. Boy, if I were an investor, I'm like, I don't know how I would invest with any of these companies with any confidence. I just don't know how this whole transition to electric is going to go. I have no idea.
Yeah, and also, where is the bottom? So, I mean, Stellantis, what was it? Its second downgrade in like 4 months or something along those lines? Like, why is it so hard to get that clarity? Like, one downgrade for earnings, okay, but why is it so hard to do it on a real-time basis? And then how do you even know when the trough is to know how to start pricing in other stuff?
Yep, absolutely. It's just, I don't think the companies really have a handle on where their demand is for their business because, again, they're transitioning from one business model that they've been in for more than 100 years to a completely different business model.
Not even that, but there's a great article out right now that says that Ford has emerged as the American firm most at risk from its exposure to China. Beating Apple, beating Tesla. So now we have to layer this in now to Ford at the same time.
Yeah, and at the same time that the Western automakers are having problems, the Chinese continue to plow ahead in the EV space, so that raises longer-term competitive issues. So tough news coming out there at the auto industry. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Major stock averages, they are lower right now to little change. Traders waiting for remarks from the Federal Reserve Chair, Jerome Powell. He's going to deliver remarks a little later in today's session. Also, traders waiting for the jobs report, the next piece of really important economic data. Going to get that on Friday as more of the focus turns to the economy and less to the rate of inflation. Among the individual leaders in the S&P 500, right now you have FedEx, ResMed, Estee Lauder leading gains. The laggards include Carnival Cruises and Micron Technology. The S&P 500 10 points lower. That is down 0.2%. We're at 50.27 on the index. The Dow Jones Industrial Average 121 points lower. That is down 0.3%. And the Nasdaq 100 right now 62 points lower. That's a decline of about 0.3%. As far as yields, they are higher 2-year, which is more policy reactive. That's up 4 basis points right now, 360. The 10-year yield, the benchmark, is 1 basis point higher. That is at 376. And looking at some of the commodity space, crude oil, Brent crude, which is the international benchmark, that's down 0.3%, 71.74. The NYMEX crude quote right now, 3 cents a barrel higher, 68.21. I have it on good authority. Actually, photographic evidence. The gasoline prices, the retail gasoline price in New Jersey in some parts is, what'd you say,
285, baby.
285. That was at a BP station.
Route 35, Wall Township.
That's good. We're happy now.
Awesome.
Send me
Life
a
is
picture
good.
over the weekend.
I sent John a picture just to.
That's because he missed you, but then it was also because he wanted to let you know. It's like my mortgage rate. It's that kind of thing. All right, I'm Alex Steele, alongside John Checker and Paul Sweeney. I'll totally send you a picture of my mortgage rate. This is Bloomberg Intelligence Radio. We cover all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. We also sometimes go outside that and just take a look at the broader market and get the nice macro view from some people who run money. And for that, we go to Jerry Kudzill, Group Managing Director and Generalist Portfolio Manager over at TCW. He joins us now from LA. There's lots of different ways to go with this, but I'm looking at a stock market that's a little softer. You have yields on the front end there a little bit higher. What is the pain trade right now for you, considering the massive movement into Chinese equities that we've seen? Where's the pain trade right now?
Well, thanks a lot. Appreciate being on the show. I tell you, this rumor about 280 gas prices has me. I think you guys are lying. In LA, it's $5 still.
Well, you have
for
a
gas
whole
in
different
LA.
problem there in LA. So there's that.
We have a whole different problem. But what I'll say is, pain trade for markets appears to be a concern about inflation, and what we would say is that's not. I don't think anyone is really concerned about that. It feels like the Fed is trying to, and I think, look, hat tip to the Fed so far. They've controlled the narrative really well. I mean, you've reset expectations only from June 1st to move rates 100 basis points lower. We had one cut priced in by the end of the year, June 1st. We're now going to have about 6, and ultimately the valuations really have been unimpacted. So hat tip to the Fed so far. Feels like the market's embracing the idea of a soft landing, the idea that lowering of inflation is a good thing, and we'll see. Ultimately, we'll see what proves out. But I think the data, certainly there's something in there for everyone as it relates to economic data right now, the bulls and the bears.
How much risk should fixed income investors be taking these days, given that rates are coming down?
That's a good question. Look, I think as we think about it, I think there's a bunch of ways to answer that question, Paul. But the reality is, rates are going to come down because inflation expectations are stable. I think the right question to ask is, why are rates coming down? Are rates coming down because demand is, the economy is slowing, and have a potential issue? And I think we'll learn a lot more as we move through the week. We're going to get a couple of economic numbers this week that will probably be pretty impactful. I would say we like fixed income broadly. You can create income in portfolios. We like the belly of the curve. What we don't think you should be doing is taking significant amount of credit risk in portfolios. We've talked about this a bunch on the show, and the reality is the risk-free rate gives you 85% of your yield when you consider investment-grade corporate bonds. And when you pull this back historically, whether you're looking at high yield or you're looking at investment-grade credit, at the end of the day, you can get the majority of that yield in the risk-free rate. And we like the belly of the curve and the front end of the curve because we think inflation expectations are stable. the curve will continue to steepen, and you'll be able to generate some healthy income without taking this volatility. We don't think you need to introduce that in your portfolios with significant amount of credit risk.
There's still money, though, flowing into money market funds, kind of like unbelievably. And the money hasn't come out of money market funds, to say the least. When does it, and where does it belong in fixed income after that?
That's it. That's the $7 trillion question, right? That's the reality. Where's the money going to go? The market at the moment is comfortable that rates are coming down, but ultimately you need the rate to come. You need the rate to come down. We think to see that money move. And where's that money going to go? Well, it's going to kind of go everywhere. I think our opinion is it will benefit the markets, but I would just pause and for us, what we would say is we're a little bit more concerned about the direction of the economy, where it's heading, and really a function of the labor market. And I think we're seeing some slowing in the labor market. And whether you have a lot of money in markets or a little money in money markets, when people lose their jobs, they don't spend money, and that slowing in the economy is we think is going to overwhelm any kind of short-term movement of money, and really going to challenge risk assets, at least performance of risk assets in the near to medium term.
Hey, Jerry, thanks so much for joining us. Appreciate getting your thoughts there. Jerry Kutzel, he's a group managing director and a generalist portfolio manager at TCW, joining us from their home in Los Angeles. Let's switch gears here. A little M&A here in the satellite television space. I never thought I'd see the day. DirecTV and Dish, they're going to merge to create the largest U.S. pay TV provider. Let's get the latest on that. Geetha Ranganathan joins us. She's a U.S. media analyst for Bloomberg Intelligence. Geetha, this is big news in the satellite business. You really only got 2 satellite players out there, and now looks like they're going to be merging here. What's driving this deal?
What's really driving this deal is desperate times kind of call for desperate measures, Paul. So satellite TV has steadily seen an erosion of its subscriber base. I mean, at one point, it was the only other game in town, along with cable TV, for people to get access to different pay TV packages. Today, the world is a completely different place. I mean, you have cable, you have satellite, which is, of course, the traditional facilities-based operators, but then you also have a whole slew of new internet-based options, whether it's a YouTube TV, which gives you all of the linear TV options, or whether it's like completely different what are known as SVOD services, subscription video on demand services, like an Amazon Prime or Netflix. And so the world today is completely different, and because of this, satellite TV has seen a huge erosion of its subscriber base. Dish and DirecTV, once upon a time, they were some of the largest pay TV operators. They have lost about 63% of their satellite subscriber base just over the past 7 years.
That's unbelievable. Did 2 wrongs then make a right? / will regulators like it?
So regulators, of course, squashed this deal back, about 20 years ago. But then again, it was a completely different landscape. They have to kind of understand that things have completely changed today. One of the main appealing points of satellite TV, why people even take it in the first place, is because in a lot of areas in rural America, this is the only way that you can get access to pay TV. But things have been changing because, we've had this whole initiative to narrow the digital divide. So more and more houses in rural America are getting wired up. And with that, they now have the option to switch to internet-based TV, which is, exactly what Dish and DirecTV are saying. This is the reason why they've lost subscribers. So this is the reason why there is more competition, and therefore regulators should allow the deal to pass.
And I guess a parallel announcement here today is that TPG Group, the private equity company, is going to acquire AT&T's 70% stake in DirecTV that TPG doesn't already own. So in effect, a private equity owner is now going to own the entire U.S. satellite television business. What's going on there? Why is this happening?
Yeah, exactly, Paul. So it's, Charlie Ergen walking away from the pay TV business. And in many ways, again, AT&T also walking away from the pay TV business. And as you well know, AT&T had invested heavily in the media businesses. They had bought the whole Warner Brothers operation, which they kind of got rid of, selling that to Discovery. And then, of course, they had also bought the DirecTV operations, which they sold a 30% stake to TPG. They still retained a 70% stake. And of course, today with that deal with TPG, they are completely exiting that that business. And for both of them, if you kind of look at what is the final end game here for both AT&T and EchoStar, or the other part of the Dish business, it's they really want to kind of focus on their core business, which is the wireless business. For AT&T, of course, it's the wireless business. For EchoStar, they have they've amassed a huge amount of spectrum, and they ultimately want to become the fourth largest wireless player in the United States. And this deal really helps them do that and kind of focus their resources, investments, time, and energy on just that part of the operation.
This might be a dumb question, but do they grow their customer base at this point? Is there a customer base to grow? Or as you said, do they just become better at execution and they kind of cut with synergies and that's how they become successful?
Yes. So yes, they are looking at they outline about $1 billion in synergies. A lot of those will, of course, be programming costs. They still will be, with the combination, they still will be the largest pay TV operator. They will have about 19 to 20 million subscribers, but there's not a whole lot to really grow, Alex. So it's really more kind of stemming the declines, if you will, just reducing the bleeding and becoming much, much more efficient in kind of delivering customized, tailor-made packages for the pay TV market.
Hey, Geetha, just about 30 seconds left. What's your forecast for just the overall pay TV business? Are paying subscribers going to go to zero? Are we going to be all streaming stuff soon?
I hope not, but we're definitely seeing that, YouTube TV is becoming a major, major player in the market. Again, they are delivering linear TV channels. They right now are, about the third or the fourth largest operator, 8 million subscribers. So they actually have more subscribers than Dish has on its satellite business. Wow. But we eventually, in the next 2 to 3 years, see them becoming the largest player. And then that, of course, changes the whole dynamics of the whole pay TV market, because then you have a streaming-based operator that's the largest operator of the pay TV market.
And again, the DirecTV and Dish getting together, DirecTV is paying $1 for the equity and assuming all the debt. So talk about an inglorious end to the pay TV business from the great Charlie Ergen, who built that satellite business from scratch about 30 years ago. Geetha Raghunathan, thanks so much for joining us. U.S. media analyst for Bloomberg Intelligence, joining us from Princeton. And again, kind of end of an era for Charlie Ergen, again, one of the leaders in satellite television, in satellite technology in general, and commercial telecommunications, putting up the satellites 30, 40, 50 years ago. So just walking away from that satellite television business, focusing on the wireless spectrum that he still retains. So we'll have to see how that plays out. But now we've got private equity owning the satellite television business. How about that? We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This is on a day when the major averages are lower to little change, among other things. We're waiting for some comments from Fed Chair Jerome Powell. We'll be parsing that, whether or not he gives any indication about future policy. And also at the end of the week, we're going to get the all-important jobs report, the focus shifting less on inflation to more on the strength of the economy, in particular employment. Among some of the individual shares on the move, CVS Health shares, they are higher, jumping after a report in the Journal that executives are going to meet today with investor Glenview Capital Management on how they can improve operations amid a drop in the share value. Stellantis slashing its forecast for the year. That's weighing on the other automaker shares as well. I'll give you a quote on Stellantis right now. Those were down 13.5%. Stellantis, just the latest in a series of automakers' lower profit projections recently. Yet Volkswagen last week just issuing its second warning in 3 months. The benchmark index in China posting the biggest gain since 2008, entering a bull market today. And the rush into the market before the week-long holiday also sent trading turnover to a record high. Right now, the S&P 500 2 points lower, 57.35 at the index. The Dow Jones Industrial Average is down 45 points. That's a decline of 0.1%. And the Nasdaq 100 right now, 29 points lower. That is down 0.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. Alex Steele here alongside John Tucker. Paul Sweeney back from his sojourn to Ireland. Are you recovered?
I am, and I had a great time.
He looks very relaxed and rested.
What's to recover from?
He
was on vacation.
Jet lag,
Exactly.
drinking all the pints, Guinnesses.
Yep, exactly.
Guinness? Can you say Guinnesses or is it Guinea? Okay, John Tucker's looking this up. All right, so one of the things we're looking at, of course, is what's going to happen with UniCredit and Commerce Bank, right? And will this ignite a ton of M&A, cross-border M&A over in Europe? Here in the U.S., we're also super fragmented as well. So as rates come down, does that mean we're going to see more bank M&A? Well, Neil Sipes is Bloomberg Intelligence industry analyst for financials, and they just had a great deep dive into a bank fee frenzy on the return of M&A. So there's two different things going on. One is actually M&A of banks, and the other is making money when M&A happens for banks. Just let's go to the M&A part first. Do you think we're going to see a lot of M&A and mergers within the financial industry?
I think we certainly could see more M&A in the financials industry. In fact, one of our internal surveys of BI analysts here showed that financials is one of the most bullish to see deal activity moving forward. That follows larger fee pools like industrials and technology as well being pretty sizable opportunities moving forward. But more broadly across the market, we do see M&A as being a pretty sizable upside in the near term over the next couple of years as we've sort of come off of 2021. Remember, that was a record for the industry, a record in fees, $45 billion across the industry. 2023 was a decade low for new M&A announcements. We think that is going to inflect as we start to get some of these rate cuts from the Fed into the market. And ultimately, we think that's going to be a pretty big upside for the investment banks across the spectrum, from the bulge brackets down to some of those smaller boutiques.
Every time we get an M&A banker coming through here, they say the backlog looks great. I'm not buying it. Talk to us about 2024. What's activity been like? Because you can't get a deal done in anticipation of rates coming down. I'm not sure when you can.
Yeah, and I think you're right in the sense that we have heard that deal pipelines have been pretty strong for quite a long period of time. The ultimate challenge has been the sort of execution ability of those transactions in the pipeline, the ability to do those at the right valuation for the buyer and seller. And ultimately, when you had such drastically shifting rate expectations that we've seen over the past 12 months, a lot of sort of those corporations and financial sponsors, to be sure, have been sort of forced to the sidelines. So those deals are sort of waiting in the wing. We think as these interest rate cuts materialize, assuming that markets can sort of digest them in a positive way, we do expect that deal activity can step higher.
Are there industries or certain type of deals that you think will be more prevalent?
Yeah, so what our expectations here within BI across our group is, we're seeing more of those bolt-on transactions, perhaps less of those blockbuster transformational deals that are really going to alter a sort of business model. So when we think about that, we're thinking about, smaller asset sales, maybe spinning off an asset, focusing on your core, tacking on technology that can either improve on the top line side or help cut costs internally. So we are expecting to see perhaps more on the bolt-on transaction side of the deal, but specifically in energy is a sector where we're expecting to see much larger transactions moving forward.
All right, talk to us about who's getting paid here. I mean, in my day, it was Goldman Sachs, Morgan Stanley, JP Morgan. Now I've got a lot of these smaller boutique firms that are really competitive. I think about the Centerviews or the JPT Partners and some really good firms doing big deals. How's that shake out?
Yeah, and so we've seen this sort of proliferation of the boutiques over a decade plus period of time. So it's not necessarily a new story, but what we've been really tracking over the past couple of years is a pretty weak M&A environment in 22 and 23. We saw a lot of these specialized boutiques, the Evercores, the PJTs, the Moelis's of the world really step in and hire talent, hiring at the the highest ranks of those managing directors that are really driving those relationships and pulling in the fees for the business. And so, a lot of that hiring was taking place when activity was cyclically low, right? So these bankers were not generating their typical amount of revenue. We were at pretty much the lowest productivity levels since 2016 last year. But what we see now as we sort of see this impending wave of deal activity moving forward, we think some of these smaller names like a PJT, like a Jeffries, who have increased their senior ranks by over 60% versus pre-pandemic levels. These are just much larger institutions than they used to be, and that implies just generally a higher revenue run rate moving forward.
Yeah, I'm just looking at, you guys have a great table here that talks about the volume increases by region, right? And obviously across the board for the US, it's still like the big guys, right? But then if you go to say Europe, it's Rothschild, it's also Lazard is doing really well there. They're growing, I should say there. Asia Pacific, this shouldn't be big of a surprise, but Mizuho and Nomura. Also, TD Securities and Wells Fargo doing really well in terms of volume growth here in North America.
Yeah, so to your point, the top of the list across categories is typically still going to be Goldman, JP Morgan, and Morgan Stanley. We don't expect them to be displaced as the leaders in global M&A, but we do see, again, some of those smaller competitors picking up share, a lot of that relating to, headcount additions, as well as, when we look at foreign markets, we see some smaller competitors relative to a Goldman Sachs that have strength in their home markets. So that's why you see some names like a Mizuho, like a Nomura. They're going to be much more focused on Japanese M&A, but ultimately you're still going to see names like Morgan Stanley and Goldman at the top. So it's a highly fragmented industry. Some of the largest players hold, of course, a large percentage of the market share, but there's a lot of activity to go around for some of those specialized competitors.
Folks at it, particularly those who have the Bloomberg terminal, BI Go, and you go to the financial section, they can get access to this big report on investment banking M&A outlook with the Bloomberg Intelligence team, Neil and his team, and Allison Williams. They do a deep dive into an outlook for M&A across industries and who will be the winners and losers on Wall Street. So a deep dive report into this thing, some 60 pages long. So the financials team putting out some great research there. Neil Sipes joining us here in studio. Thanks so much for joining us, Neil. Neil Sipes covers the banks. He's an analyst for Bloomberg Intelligence. And again, some big deep dives that Bloomberg Intelligence is doing more and more of, and really good stuff. And this one's on just kind of investment banking, business, and M&A.
Yeah, I'm really interested what kind of FTC we see whatever administration comes next. Clearly, that feels like a binary situation when it comes to Harris versus Trump. Like, we all know, okay, tariffs in China will increase, right? We all know what's going to happen with corporate taxes either way. But this one feels truly binary in some ways.
It does. And fortunately, we have some research expertise in Bloomberg Intelligence. And Jennifer Reed, she covers all the antitrust litigation. So she is all over that. And so whenever we have issues with M&A, and there's a lot. It seems like a lot of the big deals have been blocked forced to amend their terms because of anti-competitive concerns, and that is a big issue for M&A. And we have Jen Rhee. She covers all that for Bloomberg Intelligence. Looking at the markets here, pretty much unchanged on the S&P 500. The Dow's off, pretty much unchanged as well. So market's pretty steady here, waiting for some more economic data this week. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside John Tucker and Paul Sweeney. We're all back. Everything is right with the world. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance right here from our world headquarters in New York City. We have a great big take today. We dive deep into the topics and the themes that are really impacting the global financial markets. And this is really now about colleges, universities, and their endowments. Apparently, Harvard endowment paid out a fortune and has now lost its investing edge. Janet Lauren joins us now from Bloomberg Markets and the Big Take. Janet, what are your findings? What did you learn here?
Well, I went and read through a lot of annual reports of the Harvard Management Company, which has managed Harvard's endowment for 50 years this year. And one issue that came up, which is no surprise to our listeners and readers, is there's been a lot of turnover there since 2005. A guy by the name of Jack Mayer had extraordinary returns. The team he built, they paid their managers a lot of money for really outstanding returns. They got a lot of complaints. That system was dismantled. And since then, they've had 7 people running the fund, including some interims, but 2 people who stayed less than 2 years. Lots of turnover, lots of strategy changes. And, you know, Harvard was the envy of the world. And if you look at their 10-year return, you know, they were in the bottom 20%.
Why the turnover? It would seem like a pretty good seat to me.
Yeah, well, there's a lot of scrutiny. And one issue is, if you're a top performer there, you're getting paid, you show up on the tax forms and everybody knows how much you are being paid. And there's a lot of scrutiny.
So what universities are doing well if we rank them in terms of return and all that?
Well, if you look at their big rival, Yale, they're in the top 10% of returns for the 10-year annualized return and the 20-year annualized return. They've had largely one person, the legendary David Swensen, who managed their fund from 1986, a Yale-trained economist until he died in 2021, and one of his trusted lieutenants has picked up where he left off. They have a very different structure. Unlike Harvard, which used to employ more than 200 people, traders, they've always sought to work with outside managers, and they sort of were there at the beginning of private equity when there wasn't as much capital, and they seeded a lot of these managers who've had excellent returns. And you know how private equity works. You're not going to get a big return in year 1 or year 2. There's this thing called the J curve. So it takes time. And, schools like Yale and Princeton and MIT, whose CIOs have worked for Yale in the past, they all invest together, and they've all done much better than Harvard.
So, I mean, that Yale, it's referred to as the Yale model. It used to be, back in the day, a 60-40 portfolio. Then Yale said, no, we're going to allocate a lot to alternatives. I think in the simplest form, that's kind of the Yale model. Hasn't everybody replicated that?
Well, everybody's tried to, but can you get into the funds that Yale is in? No way.
Because they're still reaping the benefits of being early.
Absolutely. But now this year and last year were not great years of returns for the biggest endowments. Private equity has really lagged in public equities. This year, what was it, 23% return? The college endowments are going to be nowhere near that. I mean, to be fully in the S&P would be too much risk for them. But, we've seen a few schools report returns, high single digits. They need to get 7-8% to get to pay their salaries plus inflation.
When we talk about what they're not investing in, there's been a huge social pushback. We see it at universities like Columbia when it comes to the war in Gaza. There's obviously been a big push against fossil fuel investments. Are these endowments, what's the right word? How quick or how nimble are these endowments to respond to those?
Well, first of all, nobody is divesting from things related to Israel, but that's pretty clear. So that's not really a factor of what these colleges are doing. And Harvard did not divest from fossil fuels. They're rolling things off, and they had a loss in 2022, and they said a small portion of that was not being in the funds that did very well in energy in 2022. Divesting as a strategy really is not an investing strategy. It's what does Warren Buffett say? Don't do anything with emotion. And colleges, if that's what they're looking for, you saw meddling with the change in pay structure, meddling with energy, meddling, not such a good investment policy. And Harvard has also been pretty steadfast that they're not doing anything related to the BDS movement. For 20 years, they have been.
So, I mean, they still have $50 billion endowment. They're still the biggest.
They are.
So, I mean, I'm not going to cry for these guys, are we?
No, but also, who's nipping at their toes is the University of Texas. And the reason is they have an asset that's completely uncorrelated to anything. They have oil, and they have 2.1 million acres of land in West Texas that they were just given in the 1800s by the state of Texas. And a couple years ago, they had an extra $2 billion gains that had nothing to do with anything they did investing-wise.
That's really interesting. All right. We really appreciate it, Janet. Thank you very much. It must have taken you forever to do this. Janet Lauren, Bloomberg Higher Education Finance Reporter. Thank you very, very much. Check it out on The Big Take. It's really great. Speaking with universities, here's something. Stanford and USC are now banned from giving preference to legacy students. Did you see this?
No.
Yeah.
Interesting.
Governor Gavin Newsom signed a law that banned a legacy preference at private universities.
Interesting, because that's always been, obviously, a big issue. And by and large, my understanding is if you're a legacy, it roughly doubles the percentage chance of you getting in. So if, just for example, Harvard's got a yield or acceptance rate of 7%. If you're a legacy, that could be as much as 14%. So it's still tough, but it makes it a lot better, and that's been on decline.
Maryland has adopted a similar measure. Colorado, Illinois, and Virginia have barred the practice of public universities. So there we go. We round out your public education and private education stories for you. All right, much more coming up on the next hour of Bloomberg Intelligence. Craig Trudell on what's happening with the autos. This is
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great hour lined up for you. Danny Berger is reporting live from Port Newark Elizabeth in Newark, New Jersey. We're going to take you to her. Plus, Craig Trudell, Bloomberg Global Autos editor, will be joining us on what's happening with the European automakers, but also Ford, GM, Stellantis, all here in the U.S. slipping as well. Plus, Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst. Carnival upgraded their forecast. We'll check in on what the stock is doing. And RJ Gallo, Senior Portfolio Manager, Fixed Income at Federated Hermes, his take on the fixed income space. We are also waiting for New York Governor Kathy Hochul to talk about the state of preparations for that potential East Coast port disruption. We'll bring that to you live as well. But let's kick this all off with Charlie Pellet with the Bloomberg Business Flash.
Thank you very much, Alex and Paul. And we are looking at a down day right now. Key takeaway, little change on the S&P. We're brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Do want to begin with a developing story headline right off the Bloomberg Professional Service. The tech company Ingram Micro Holding is filing for an IPO. It'll seek to list on the NYSE under the symbol INGM. So Ingram Micro Holding filing for an IPO. Stocks and bonds wavering as traders await remarks from Fed Chair Jay Powell later in the session. Those remarks will be broadcast live on Bloomberg. We've got the S&P right now down 3, little change, down just under 0.1%. The Dow down 63, down by about 0.1%, while NASDAQ is down 23. For the NASDAQ Composite Index right now, a drop of 0.1%. 10-year 3.77%, with the 2-year 3.60%. Spot gold down $25 the ounce, down 0.9%, 26.33. And West Texas Intermediate crude 68.70 for a barrel of WTI, up now by about 0.8%. Well, as I mentioned, Fed Chair Jay Powell will be speaking to the NABE conference in Nashville just under 3 hours from now. Kathy Jones is Chief Fixed Income Strategist at Charles Schwab.
It's hard to imagine he's going to tread any new ground in this speech. I think he'll probably be very clear that things are going well. We do have a great soft landing scenario right now. He'll probably warn about some of the risks ahead and say that the Fed's attentive to those.
And again, 10-year right now, 3.77%. By the way, today's Powell remarks will be moderated by Ellen Zentner of Morgan Stanley. Yes, you can catch it live on Bloomberg Radio. Stellantis, the parent of Chrysler, Jeep, and Fiat, slashing its forecast for the year, citing plans to lower production and spend more on promotional incentives. Stellantis plunging 13.9%. GM down 3.1%. Ford lower now by just about 2%. We'll have a whole lot more on the auto industry coming up with our Craig Trudell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Right now, let's go to New York Governor Kathy Hochul. She's making some comments about the potential East Coast port disruptions. Let's listen in.
You may have heard the news that contract negotiations are going on between the International Longshoremen's Association. That is the union that represents port workers all across the country, and USMX. Now, that deadline is rapidly approaching. If an agreement is not reached by later today, ports from Maine to Texas will face a strike. 47,000 workers, 4,500 of which are right here in the New York and New Jersey area. And we represent the largest port on the East Coast, the second largest in the nation, so the busiest in the nation. So I want to be clear, I urge USMX and the ILA to come to an agreement that respects workers, that ensures the flow of commerce through our ports, and the stakes are very high. The potential for disruption is significant. We've not had an event occur like this in our ports since 1977, and that lasted 12 days. We're deeply concerned about the impact that a strike could have on our supply chains, especially when it comes to critical goods like medical supplies and others. That's why I've been working tirelessly, particularly for weeks, but in earnest over the last week, to deal with every aspect of this. And you'll be hearing about the extraordinary measures, the long hours, the days, the weekends that have gone into really trying to make sure that we're prepared for this and addressing all the vessels that are in our port now, removing the cargo containers, and there'll be 100,000 cargo containers that'll be sitting in one of our 16 locations, filled with everything from automobiles to consumer goods. We have been preparing for that and rapidly trying to take them off the ships now, get them on trucks, and get them to their destinations at a hyper speed, because we know the urgency is before us. So I want to make sure that while we hope for a resolution of this matter, that New York is fully prepared. We have been anticipating this. We're fully prepared to support our communities and maintain essential services if a strike does occur. I'm going to outline some of the steps that we're taking to prepare for this. The Port Authority of New York and New Jersey, as I said, has been working round the clock to get critical cargo out of our facilities, food products, medical supplies, other essential goods. We're also working closely with the commercial trucking industry to ensure that these items reach their destination. This will be a major disruption for thousands and thousands of independent truckers as well. We're really focused on medical supplies and making sure that all facilities have what they need to continue caring for their patients. Number one, when it comes to pharmaceuticals, I'm pleased to report that the majority of pharmaceuticals arrive to their destination by air travel, so that pharmaceuticals are not expected to be in a problematic situation. But I've directed our Department of Health to remind our healthcare workers that they're required to maintain 60-day stockpiles of personal protective equipment. We saw the need for this during the pandemic, as well as other supplies. We're closely monitoring this situation and ready to deploy state resources if and when necessary. Again, Department of Homeland Security, coordinating with all of our state agencies to prepare for any shortages of essential goods and materials. Our state stockpiles, including emergency generators, are ready to be mobilized at a moment's notice. While we're preparing for the worst, and that's what we're supposed to do in government, prepare for the worst, there's also some reassuring news. We don't anticipate shortages of essential goods anytime soon. So, for example, people do not need to rush out to the grocery store and stockpile goods like they did during the pandemic. I want to be very clear about that. We do not want to see people reach that level of anxiety, because we are not there. Also, fuels like home heating oil, gasoline, diesel, we don't expect them to be affected in New York City because they're brought in by other vessels. And this is critical as we particularly approach the colder months. Municipal solid waste operations will also be unaffected in the event of a strike, meaning your garbage will continue to be carried out.
All right, that's New York Governor Kathy Hochul giving some comments as the region and the state and the region prepares for a potential port strike that could begin as early as midnight tonight. So bringing you those comments there. Right now, let's get right back to get some more reporting right on the ground. Danny Berger joins us, Bloomberg Television host, on these as the eastern ports prepare for what is likely to be a strike here. She is at the Port Newark Elizabeth in Newark, New Jersey. Danny, thanks so much for your reporting all throughout the day here. It certainly appears here, just listening to Governor Hochul, that the region is preparing for a strike. Is that the feeling at the docks?
Yeah, it certainly is. I mean, you heard it there. They're getting ready with medical supplies, making sure that they're set up in a way. And you could hear from her comments The world is maybe, or at least America, is more prepared for it this time around because of the lessons from COVID, for her talking about needing PPE here. But it is a region, an entire East Coast and Gulf Coast, that is getting ready for a strike. It is the International Longshoremen Association, which represents 45,000 workers. They will go on strike unless an agreement is reached, and so far it seems like that is not going to happen. They will go on strike at 12:01 a.m. Eastern. The strike, the disagreements, it is over pay. They want an 80% increase over the next 6 years, and they want language written into their contract, significant language that says that they will not adopt automation that could threaten jobs.
Yeah, it was interesting to hear her talk also about trucking. Mike McKee, who's also covering the economic impact, had a great stat, because this will be disruptive when it comes to the inflation and jobs data that we wind up getting. He says, basically, the jobs number that we're going to get for October, 4 days before the election day, you're going to have a payrolls report that is confusing and hard to read if the strike goes on for a long time, and then you have the Boeing strike at the same time. That's going to be quite interesting, especially headed in to that Fed meeting. Are you hearing or talking about trucks at all? Kathy Hochul, the governor, was talking about containers going to be offloading all their supplies onto trucks.
Yeah, so we actually had extended hours here, at least in the ports of New York and New Jersey, extended hours so they could hurry up this process to make sure that things were offloaded as quickly as they could. Now, you can do that perhaps in the northern regions. Get ready for that. The problem gets a little bit more difficult when it comes to the south of the United States. They've been dealing with Hurricane Helene. If you want to hurry up, extend port hours, get onto trucks, you can't do that in the middle of a hurricane. So when it comes to preparation, sure, you can try to speed it up along here, but just more throughout the entirety of the United States, that's not exactly an option. Another option, you could say, okay, can you just divert the ships to the West Coast? The West Coast in Canada, by the way, there's a strike happening at the Port of Montreal right now. It doesn't have the same capacity to absorb the additional flow. So in terms of options, it's really few at this moment.
All right, very good. We really appreciate it getting your thoughts there. Danny Berger, Bloomberg television host. She is at the port of Newark in Newark, New Jersey, on the ground there. Looks like that strike will occur at 1 minute past midnight tonight. We'll keep on with that reporting. Let's get to the other significant story, I think, out of the day, which is just this real sell-off in global auto stocks here. Stellantis with a profit warning that came in much more egregious than maybe I think people were discounting. That stock is off 13-14%. Craig Trudell, Bloomberg Global Autos analyst. He's an editor there. I'm sorry, Bloomberg Global Autos editor on the slowdown in the European auto industry. So, Craig, it seems like this auto industry globally, certainly for the European operators, the North American operators, this transition to electric vehicles is proving much more, I guess, difficult than maybe the market had anticipated. Where are we here? What's happening with these big auto companies?
Yeah, I think that's spot on. I think in the case of Stellantis, you had a company that, especially in North America, was really taking its sweet time in terms of going electric. And they're now really caught in a bind because they've spent an awful lot on playing catch up. They have, some electric vehicles, some plug-in hybrids coming to market just as that market really slows down. And they've maybe invested in that at the expense of some of the vehicles in their lineup that, really were strong sellers and that dealers were quite fond of. If you look at, Jeep or Ram, some of the major brands that, Chrysler, has for a long time been shepherding in the U.S. This is a company that, has way too much inventory, has been trying to take too much price for too long. And, the CEO, Carlos Tavares, has taken some blowback over that, even from dealers, and in a really unusual way for the head of the U.S. Dealer Council to issue a public letter a few weeks back criticizing him and criticizing the company was really remarkable.
What I'm having a hard time understanding is why it's hard for these companies to get a true handle on why things are bad. So just the idea that Stellantis cuts its forecast again in just a few months, why is it so hard for them to get a read on their own business?
Well, I think in the case of Stellantis, you've seen actually sort of a reluctance for them to lower their guidance. So they did release a very disappointing first half result a couple months back. But the companies that maybe have had a harder time getting a handle on earnings, I would put Volkswagen in that camp. They've had their second warning in the matter of a short period. I think Nissan may be next, as we reported earlier today. I do think that this is a case where, automakers globally, very quickly went from this position of being, production constrained and, looking to move as quickly as they possibly could to ramp production back up. And, once they were able to get through the many supply chain issues that they've had over the last few years coming out of the pandemic, it really took them some time to adjust to the fact that, at some point they were going to get to where they were no longer production constrained, that, demand wasn't going to live up to what everyone was making. And it was kind of a matter of who was going to blink first. And, I think Stellantis maybe is getting, bonked on the head today because they were one of the last to really sort of bow to reality that they had way too much supply relative to the demand that was out there.
So is there a consensus growing here, Craig, about how this industry is going to continue to make this transition to EV? Because it seems like it's slower than maybe they had thought as recently as a year ago, more bumpier. How's this going to play out? Is there any consensus building?
I think there's probably going to be more collaboration. We've heard, the CEO of Renault in France call for an Airbus of autos, a coming together of European companies to try and, confront these challenges together. I think you've seen some analysts call for more collaboration among Western companies and Chinese companies. And we're seeing that in Stellantis, right, where they're teaming up with Leapmotor, one of the smaller EV makers in China. But I do think that there are some real limits to that latter strategy, given the sort of appetite for that in Washington, right? I think it's the one thing that's really uniting Republicans and Democrats is this idea that, we shouldn't be at all reliant on China going forward, and that they're our enemy and not our friend.
So what I also find interesting is that it's not just China and it's not just EVs. I mean, specifically, Stellantis said Jeep sales. So it's easy to blame China cheap EVs. It's easy to blame the fact that people don't want to buy EVs right now, but that's not necessarily the only problem.
I think that's a really key insight. I think this was a case of mismanagement on Stellantis's part. And you've seen some analysts come out with really sort of harsh words, not only for the way that they've sort of bungled things, but the way they've communicated. Even just last week, the CFO of the company, was talking about the sort of outlook, and the company has not necessarily been forthcoming, even as one European company after another was issuing profit warnings. For them to sort of drag their feet and only do so now when the writing maybe seemed to be on the wall, even when they were doing first half results. I think that's part of why you're seeing this negative reaction, because some are saying, how can we trust this management team, going forward, given the way they've messaged this.
All right, Craig, thanks a lot. Really appreciate Craig Trudell joining us. Bloomberg, no, you're not Bloomberg Intelligence. He's Bloomberg Global Autos editor. I weirdly promoted him, I think.
Yeah, I did the same thing too.
You did the same thing?
Intro, yeah. So
cool. It just means that you're super smart. All right, thanks so much, Craig. We really appreciate it there. Looking at the stocks, though, they're just getting really smoked right now. Stellantis ADR here in the U.S. is down by about 14%. Ford GM also down in sympathy as well. All right, coming up, we're going to go back to the bond market. The sell-off is now all across the curve. RJ Gallo, Senior Portfolio Manager, Fixed Income at Federated Hermes, will be joining us as well. Plus, Carnival reported earnings today. I'm taking a look at the stock. It's down 3%, but I thought they upgraded their forecast. We're going to break that down with Brian Egger of Bloomberg Intelligence. Happy Monday. This is Bloomberg.
This is breaking news from Bloomberg.
All right, let's head back to the Port Authority of New York and New Jersey, where New York Governor Kathy Hochul is taking questions about the potential East Coast port disruptions.
Not days, weeks. And most of what we would consider as consumers, the things we want to go out and buy, are here. They're in warehouses. They've been here for a long time. So that, you will not see effects for weeks, assuming that this plays out. And the governor's right. There might be a product here or there, but it's weeks before regular consumers feel it. There might be a handful of industries, a specific industrial plant in New York that we'll have to work one-on-one with to ensure that they have the raw materials they need.
Governor, are you concerned, off that question, if this continues to last, or if it does last longer than you think, could it negatively impact Democrats, especially in these congressional districts that you really want Democrats to take back?
It's no secret that I want Democrats to win in those congressional races. The election is in a matter of weeks. I don't anticipate that people will have a sense that this is disrupting their lives before that time. If it's still going on after that, we'll be taking other extraordinary measures to ensure people have what they need to fully function. So we know how to manage. I've managed many crises in the 3 years I've been governor, so I have an incredible team that'll make sure that this does not bleed over into people's lives, and therefore I do not believe it'll have a political impact either.
Great. Thanks, everybody.
Thank you.
Governor, we'll be back in a minute. All right, that was Governor Hochul, governor of the state of New Jersey, just giving some thoughts here about the Port Authority of New York and New Jersey and how it intends to deal with what looks like to be a pending strike taking place at midnight tonight on the East Coast and Gulf Coast ports. So we want to bring you some of that. Speaking of ships, let's go to the cruise line business. Carnival Cruise Line reported numbers that I thought were in line with a little bit better, took their guidance up, but stock's down 2.8%, so I don't know what's going on there. But Brian Egger does. He covers the cruise industry and lodging business for Bloomberg Intelligence. He joins us here in our studio. Brian, break down Carnival Cruise Lines. How did their quarter go? What's their guidance kind of tell you here?
Yeah, so overall, strong quarter and more of what we've been seeing in the past, which is strong onboard spending, close-in bookings look really good, and overall, the demand pace from the consumer's perspective is quite strong. I can't really attribute anything to the specifically to the stock price decline. I do know there was some discussion on the call about the effect of expense timing, higher dry dock costs, expense timing going into the fourth quarter, but that's generally in line with what was previously expected and not at all indicative of any kind of systemic cost issues. So overall, I mean, from a demand perspective, compared to the other sectors we follow, cruise lines have not shown any crack.
Yep. Where are they in terms of deploying their fleet? Are they fully deployed now? Do they keep ships in port? I don't know what they do here. How does that work?
Yeah, they're fully deployed. They're back to full pre-pandemic levels of deployment and occupancy. In fact, one of the pieces of good news going, I think, into next year's cost growth, or I should say capacity growth, is quite modest. So that kind of is another favorable factor in terms of yield demand for next year.
What do we think the relationship is between, say, U.S. GDP and Carnival? Like, how recession-proof or not recession-proof or sensitive are they?
Yeah, I've generally viewed cruises in general as being modestly cyclical, but if you go back historically over decades, passenger growth has kept pace with supply growth even across weaker economic periods. So although this is broadly a consumer cyclical, it has generally proven to be less cyclical than other sectors because of the significant penetration expansion opportunity, getting more first-time cruisers.
We've heard from Carnival and from the other cruise lines that demand, as you mentioned, remains very strong. Why aren't they just launching new ships, cranking out new ships to meet the demand and try to take advantage of this?
They're doing that, and over time, you're going to see kind of this mid-single-digit capacity growth measure. It just happens to be a point in 2025 where the level of capacity growth is like 0.7%. So it's a more modest period of growth here, which I think probably entering some period of economic uncertainty, not itself a bad thing. They're also adding more amenities other than new ships, like their private island destinations and things of that sort.
Private, excuse me,
Very
what? Wait, so I take a cruise to a private island? Whose island?
Yeah, so Celebration Key is one of those private destination islands that most of the cruise companies have, and that's something that they're going to be unveiling going into next year. So I think that, combined with generally strong pace of demand, and the fact that on the ships themselves, the onboard spending really has not let up, those are all very favorable factors. And we're obviously watching this closely given all the understandable concerns about what happens with the consumer if there's any kind of economic slowdown.
What's the biggest cost drivers that these companies have to manage here?
Yeah, I mean, generally fuel has always been something we watch carefully, but fuel, food supplies, it's kind of a different kind of labor composition than other industries. But certainly if you look at the cost growth picture, things that are always, we carefully watch are things like foreign currency exchange movements and fuel cost growth.
How about this whole clean thing? Do they care about that stuff?
Oh yeah, no.
Talk to us about that, 'cause I know they were talking about trying to reduce their carbon footprint, but I see these things steaming down the Jersey Shore. I'm like, I don't know.
Yeah, but also, like, are you not going to go on a cruise because of that? No. Like, you're going to fly on a plane.
Yeah, exactly.
Anyway, sorry, go ahead.
Yeah, it's okay. So whether it's liquefied natural gas or other types of fuel, they're trying to basically have a cleaner type of industry overall. Obviously, it taps energy resources, but that has been a big focus throughout the industry, is trying to minimize their carbon footprint.
All right, Brian, thanks a lot. Really appreciate it. Brian Egger, Bloomberg Intelligence, Senior Gaming and Lodging Analyst. Very much appreciate it. All right, joining us now on the bond market, because you're taking a look at a sell-off pretty much across the curve. You got the 2-year yield up by 5 basis points, 3.6. You're also looking at the 10-year up by about 3 basis points, up at 3.77. Joining us now, RJ Gallo, Senior Portfolio Manager at Fixed Income at Federated Hermes, joining us on the space. All right, what's your best bet on the curve right now?
Well, good morning. Our view on the curve has been for quite some time, and this is a pretty widely held view, is that the U.S. economy is unlikely to turn into a recession, but at the same time, the Fed is completely shifted their focus. They had been almost like a sole mandate inflation-fighting central bank when we had CPI north of 6%, all the way up to 9%, if you recall. They now have shifted gears, and the sort of the weight now is more on the employment side of the mandate. So the Fed's in easing mode. That should bring shorter yields down. At the same time, we're heading into an election. The economy, according to the Atlanta Fed, GDP is still growing around 3%. So longer yields might not come down nearly as much. That's a bit of a steepener, and we've had a good success generating some excess returns to that on a year-to-date basis. On duration, we thought that bonds were going to have a pretty good year this year, and they are. Since April 30th, the U.S. aggregate index is up 8.24%, and the Treasury index is up 7.6%. How's that for a heck of a run for less than a year's time in the bond market?
Exactly. Look at these guys doing laps here. How about the high yield business? That's actually been the best performer year to date, RJ. Why is that, and kind of how do you look at that market going forward?
You know, you're absolutely right. On a year-to-date basis, the Treasury index, just to give some context, is only up 4.08%. The number I shared before was from April 30th. So the Treasury index is just over 4, and the ag is around 470. High yield is almost 8, 7.98%. Why is that? Well, the economy has proven resilient beyond nearly anyone's expectations with respect to the drastic Fed hiking and now easing that has gone on, and the disinflation process that has occurred. The view of a soft landing is a risk asset winner, really. Look at stocks. They're up double digits year to date. If you can have the ability to slow down inflation without sharply slowing down the economy, that's very favorable to risk assets. And that's been wind at the back for high yield pretty much all year. As a firm, I'll be frank, this is a tough business. Sometimes you get them right, sometimes you don't. We've been a little underweight high yield in our multi-sector portfolios, and that's been a little difficult. However, we've made up some of that pain by being overweight mortgages and by playing the curve in the rates direction to some degree. So there's a lot of levers to push and pull in fixed income.
When we talk about, say, jobs data that's going to come out on Friday, right? I'm wondering, what do you think the reaction function of the bond market is going to be to that number?
With the Fed's shift in mandate, like I was saying a few moments ago, the jobs data becomes all the more important. We went through an extended period there where jobs data took a backseat to inflation. Now that is the opposite. I think that Chairman Powell at the podium recently after the September FOMC suggested that they're going to be sort of mentally haircutting the employment report, especially the non-farm payroll numbers, sort of the headline figure. And that has everything to do with the fact that data out of the Commerce Department, which is used to periodically revise the payrolls data that we're familiar with from the Bureau of Labor Statistics, the Commerce Department data has been weaker, less job creation. So that took about, I think it was 890,000 jobs or so. off the board. And that is, as a result, sort of casting some shade, if you will, in terms of the quality of the data that we get from the Bureau of Labor Statistics. So if we get numbers like, 120, 130, 140, I think that the market will view that somewhat dovishly in a bond-friendly sense, that it sort of keeps the Fed in the game of sequential easing, significant easing to come. Conversely, if the data is really strong, I don't know if yields would rise that much. I think that yield direction in the near term is more symmetric in part because we're heading into an election season. We're heading into an election itself. We've been in the season for a while. The outcome of which could have a significant impact on overall fiscal policy, to include stimulus from extending expiring tax cuts. If President Trump is to return to the White House, we have tariffs and inflation concerns to think about. If it's Kamala Harris, then it's another picture. She also increases the deficit, maybe a little less. Those are factors I think that are going to become pretty important as we get past the election and see what happens next.
I'm a big fan of municipal bond market. RJ, I'd love to get your thoughts on munis
What?
here.
You couldn't just wait till Friday? Come on, man.
Exactly.
I know you have the muni moment, but I'm happy to do it here too. It's funny. The muni market came into the year at a relatively rich point. And for those who are in munis, it tends to be a playground for individuals who want relatively high quality investments. The average credit quality of the muni market is around AA, much higher than corporate bonds. They also are very drawn by the tax benefits of interest-free, tax-free interest. And so that's going to bring in people who can benefit the most from it, people who are the top few tax brackets. So the year started out with a lot of optimism on bond returns, higher absolute yields that increases the value of that tax exemption in a sort of taxable equivalent sense. So demand has been pretty good for munis pretty much all year, but that meant we started the year at a sort of a rich point, and then supply has surged. We've had one of the busiest supply years in a very long time. It's up like 35% year over year. It might even be a record year when it's all said and done. So when supply and demand and relative price matter, munis on a year-to-date basis are not up quite as much. As I said, treasuries are up 4, the ag's 4.8. Munis with no adjustment for their tax benefits are only up around 2.9%, 2.2%, depending upon which index you look at. And that's because of that supply-demand pricing picture that we've seen. Right now, munis look sort of reasonably valued, maybe a little bit to the